The market probably is a bit cautious, but I think it's not expecting too much.
If the AI story gets questioned, then the whole thing probably starts to slow down.
It's not just risky assets. It's not just the AI right tail.
We can play different trends here in different ways that aren't as overpriced as the overall market.
The interesting part is the only trend is all systems go.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Monday, taking down the temperature.
I think we're going to be fine with China. Look, I have a great relationship with President Xi. He's a very tough man. He's a very smart man. He's a great leader for their country. He's a great leader. And I have a great relationship with him. I think we'll get it set.
President Donald Trump attempting to put a lid on rising tension with China. As reports suggest the Pentagon is looking to stockpile critical minerals, JP Morgan is making a $1.5 trillion promise to help boost economic security. That effort is still building.
And that news just crossing the wires currently with JP Morgan adding $500 billion to the total that it already was planning to help finance. They're using about $10 billion of their own capital to make equity investments in some of these crucial companies. It comes at a time where every private asset manager has been trying to get into this field because this is something that clearly is a priority for the United States. And in many ways, the U.S. is finding itself at its back foot because of its reliance on China for these rare earth minerals.
There is a fantastic stock market proxy, MP Materials. Check it out in the pre-market. It's higher by more than 11%, capturing the tension between the US and China. So I get the framing right now this morning. The president's backed away from the threat on Friday. Equity futures bounced back. But the tension over critical rare earth minerals, that's going nowhere anytime soon.
Absolutely not. And it's why you see the administration doubling down when it comes to what is going on with the Pentagon and making sure that there's billions of dollars that they can use to go into this space, as well as taking direct equity stakes into these companies. J.D. Vance, the vice president over the weekend, said it's going to be a delicate dance. And that is what is going to be between now and November 1st. The president said on Air Force One, from now until November 1st, it's an eternity for him.
This is quite a quote from JP Morgan's Jamie Dimon. Check it out. It has become painfully clear that the United States has allowed itself to become too reliant on unreliable sources of critical minerals, products, and manufacturing.
This builds on what he's been talking about for a while. Back in 2023, he wrote that U.S. supply chains for critical products and minerals, quote, must be domestic or only open to completely friendly allies or partners. This is something that has been on the docket for quite a while. How much is this going to be co-investments with the U.S. government in some way, sort of coalescing around this idea that, yes, the U.S. is investing, but so too needs some of the big corporate partners?
Take out what this means for the stock market and advanced technology in these chips. Magnets, rare earths, are needed for virtually every single weapon system. China owns them, processes them, refines them, and sells them. The entire supply chain is built around Beijing.
The futures bouncing back this morning, higher by 1.3%, following the biggest one-day loss going back to April in Friday's session. Equity futures firming up. Coming up this hour, Tchir of Academy Securities with stocks bouncing back. Norman Roule of CSIS as the Israel-Hamas peace deal begins. And Sonja Marten of DZ Bank on the dollar's safe haven status. We begin this hour with stocks rising as President Donald Trump takes down the temperature with China. Tchir of Academy writing, maybe this is it, and we are back to what passes for normal. But there is little to indicate China's stance has changed at all. This escalation was not started by the US, it was started by China. Peter joins us now for more. Pete, good morning.
Hey, good morning, John.
I think your framing is really, really important. Can you de-escalate something you didn't start?
Right. So I think there's two competing narratives, and I could not be any happier than with the announcements that you just made that JP Morgan said, right? I think the world is at the early stages of almost an ESG type moment, but it's about rare earths, critical minerals. We've been calling it production for security at Academy Securities for the last 6 months. We've been trying to catch that on. No one seems to be listening. It's been great for the portfolio of companies that we've had. And I think this is just going to expand and expand, right? Everyone's going to look and say, we need to do these things ourselves. We need to do that. I think that's part of why China's actually ramping things up is they see the government finally taking some steps. So their bargaining chip disappears or dissipates over time. I think they're going to put pressure on. So I do think we're going to have economic friction, tariffs with China, so that's going to be a bit of a way on some parts of the market. And the other part, anything that's production for security, pharma, tech, chips, rare earths, critical minerals, natural gas, all those things should do very, very well. We need to produce electricity. We know it. I think that's finally catching on, and it might be even global.
Pete, just build this out. China wants to make this transition painful. That's what you're seeing here?
Yeah, I think China wants to make this transition painful. I think that's their card. They're trying to build up their own chip industry. So I think they're willing to disconnect. It's up to us. And what was exciting today, even on the way in, you're listening to more and more European countries, I think, come to this realization. Why did we give up our entire industrial base? Like, we might not need to make socks. There might be things that we don't need to make, but germanium, rare earths, and we need to produce electrons. We need to produce electricity. I think this is just a giant wake-up call.
Well, it raises the question of how much pain there's actually going to be. Mike Wilson over at Morgan Stanley is saying that there could be something like an 11% drawdown for the S&P. Should this really proliferate? It doesn't seem like that's that much if you really think about the auto industry, the smartphone industry, all of these key areas that depend on these rare earth minerals.
Yeah, and I think what we'll probably see even within that is a big shift to what areas really do well. And I think as people scour their portfolios for, I think last time I was on, we talked about using AI to just go through and search for companies under $10 billion involved in these industries. I think you can expand that. This is going to be bigger companies, people looking at that. People are going to walk to the White House and say, hey, how do we work with you? I think this is really a snowball effect. So those areas will do really well. And I think finally, I dare say it, but I think the Russell 2000 can now start really outperforming the NASDAQ 100 because that's who's going to benefit from this real big focus on domestic production.
And we actually saw glimmers of that on Friday. I'm curious, though, going forward, who stands the greatest pain? Is it China or is it the U.S., given that China has shown a willingness to push its companies, tech companies, away from using U.S. chips, and the U.S. sees its entire manufacturing base disappear when it doesn't have access to these elements?
One thing that's clear to me is Chinese people will bear greater pain. So I think that's an issue as we face this, right, is Xi can push on his people and force them to deal with stuff, I think, much longer than President Trump can. So if this drags on and gets ugly, we are at a disadvantage there. Having said that, I think China's making a big bet on their own ability to develop their chip industry, develop AI. They've got the electricity. Will they be successful? I think they've got the money pouring into it. They've got the engineers. But China tends to go in a certain path. And if that path is the wrong direction, they have to go back to square one. Whereas we have all these entrepreneurial aspects. We're developing in so many different ways, and things bubble up to the surface. So that's been our competitive advantage. So I don't think it's a bygone conclusion that China can succeed. We are going to need to push regulation, deregulation. We need to do these things. I think Europe has to do the same. If we can do this all right, I think we win.
How long does it take to build what China has in terms of the critical minerals and the supply chain around it?
I think reality, a decade. I think we can do a lot in the coming year, 2 years. I think the one thing this administration is going to have to back off on a little bit is their anti-solar stance. I think solar, the only way we're going to get electricity really ramping up quickly, solar, we're probably going to have to use clean coal, which I know the president's a fan of. I think natural gas becomes a big source. But we also need to be planning and ramping up nuclear and production for things that will come online maybe 5 to 10 years from now. But if we set these things in motion, I think it was the start of that scared China a little bit, is why China's being a little bit more aggressive. We need to follow through on this, though.
So what is this relationship like in the meantime?
I think it's a lot of friction. I think people trying to game each other, trying to figure out ways around it. Hopefully we've stockpiled some of these. Hopefully we can go through periods of negotiation where China decides to sell it. But I think this is going to have to be, again, we almost talked about this as a Manhattan Project type moment where we need to focus on this desperately. And again, it can't just be us. Europe has to be looking at this, right? All these countries that kind of gave away their ability to produce what they need for security have to revisit that. And it feels like we made a lot of progress in the past week. I don't know why it took 4 years of us ranting and complaining about this, but finally something's happening.
You hear, say, 10 years, and I hear more than one political cycle. And we need to make sure Europe is in line, sure. But we also need to make sure that this is a bipartisan effort, both left and right. Refining these critical minerals is dirty. It's messy. And we've allowed the Chinese to do that almost precisely for that reason. Right. It's a messy process. It pollutes a lot. Do we have the commitment on both the left and right to park the green agenda and do what you think we need to do?
I think we're getting there, because part of this was we closed our eyes. Oh, well, if China's doing it, it's not really dirty, or it doesn't bother us. Right now, some of this is going to be locally dirty, but a lot of it's just pollutes the entire environment. And I'm willing to bet that if we put the effort in, we can do it cleaner. It'll be more costly to do it here, but we can control the process. Why would we let China do this? Why would you go in and inspect a factory in China, say, oh, this seems reasonably clean, knowing that the second you turn your back, leave the country, they're probably not operating at that level of efficiency. So I think, again, we should control our own destiny. Yes, some of this is dirty, but it's being dirty somewhere. Again, I've been really happy. The number of charts I've seen about CO2 production and showing what Europe's done while China's done this. So, yes, it's bad that we've been trying to make these steps, but if China's out there not caring, we're losing. So I think this is something that people are getting on board with. I think Europe's going to be, slower to embrace this, but I think at least the seeds are there. So maybe they're a year behind us. I think we're getting close to that point where the U.S. just realizes we cannot be dependent on these things that are super critical. And it's easy to forget, these tiny little pieces of tiny component. If we don't have them, the product doesn't get finished. I think that's where we're headed.
So let's talk capital allocation. You touched on it. You buy the constraints, things like critical minerals, maybe energy more broadly. You sell the potential overcapacity. Where is that potential overcapacity now?
I think maybe in the data centers, maybe that's where we're looking at. Maybe some of the consumer credit things, some of those, there's issues there. But I think so you can be maybe a little bit underweight. I think you want to own some of Europe. I think Europe it's probably a bit early for this particular bandwagon, but I think this bandwagon's really just starting to take off. It's going to be the equivalent of, you're going to see fund launch after fund launch, ETF launch after ETF launch, trying to capture this, right? It is the zeitgeist of the moment, finally. And just like you may have shook your head and wondered why some of these things went on too long, I think that's the moment we're going to have here. I've sold some of my positions. I really regret selling anything in this space and probably have to chase it and buy back because I do think we've had this sea change.
Can I just finish on private credit?
Yeah.
We've had some events more recently. And some of these stock market, public market proxies for what's happening in private credit, KKR, Apollo, Blackstone, they're down around 20% since the middle of September. Those stocks have been absolutely hammered. Are you worried about these credit events becoming a broader economic story?
At this stage, I'm not really. I think some of these, with Treyz, it's probably tied to some of the immigration policies because a lot of their clients may have been forced either out of the country or out of jobs. So I think these are one-off things. I think private credit's this, whole easy thing to be a big boogeyman and, ooh, what's going on in private credit?
Yeah.
I believe since the GFC, it's become a cottage industry to look for the next credit bubble. I just don't see it in private credit. I don't see the leverage on leverage within the system. I think most of the deals have been decent. These companies will negotiate, will go through a lot. There will be hiccups, but when I talk to the investors, I don't think people walked in and said, oh, I'm going to get 10% risk-free. I think people understand there's some risk in this. The overall portfolio effect will be good. I would be much more cautious of some of these smaller, newer entrants who may not see the big deal flows the big people saw, right? The big, large dealers, they have all the deal flow. They saw the deals they wanted. They could pick and choose. They had leverage. They had the negotiating power. I don't see this becoming systemic, though I am watching BIZD, or ZD, sorry, or ZD, I guess. Confused which country I'm in after the last week. But, it is a BDC ETF. That is lower than it was back in April. That's a bit concerning. So, you can't ignore what the market's telling you. So I'm looking at that. I think it's probably overdone, though.
I get confused, too. The Brits say Z and we say Z here in America. Peter Tchir of Academy. Pete, thank you, sir. Appreciate it. I'm not sure that the people over at Apollo, KKR, Blackstone will want their businesses reduced to the fate of, say, First Brands and the likes of Tricolor. But ultimately, that's the situation, the way they've been traded over the last few weeks.
People are worried, and they are worried that it's been untested through a credit cycle. And you raised a point that this 10-year cycle is more than one political cycle in terms of building out some of these resources. It also potentially is more than one credit cycle. And a lot of what's going to finance this is not the politics, it's the credit. And I wonder how much of that credit's coming from some of these private asset managers. So these are connected stories in a very deep way.
There's a better mood this morning. Stocks are higher by 1.3% on the S&P 500 with an update on stories worldwide. With your Bloomberg brief, here's Yahara Anand. Hey, Yahara.
Hi, John. President Donald Trump speaking at Israel's Knesset soon, following the release of all 20 living Israeli hostages from Gaza. You can see live pictures there of that. Under the terms of the ceasefire agreement, Israel will free almost 2,000 Palestinian prisoners and has pulled back troops from most populated areas in Gaza and agreed to allow more aid into the territory. Meanwhile, the Trump administration is signaling it's open to doing a deal with China days after announcing new 100% tariffs effective November 1st. The relationship between the two countries soured last week when China announced new export controls on rare earths. President Trump posted on social media, quote, "Don't worry about China, it will all be fine." And as you guys mentioned at the top of the show, JP Morgan announced a plan to invest $1.5 trillion in U.S. security industries over the next 10 years. The campaign will ramp up the amount of capital, resources, and personnel that the bank already dedicates to a variety of sectors, such as rare earth minerals, pharmaceutical precursors, plus ventures developing defense, aerospace, and energy technologies. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. More from Yahara later this hour. Up next on the program, attempting to de-escalate.
I think we're going to be fine with China. Look, I have a great relationship with President Xi. He's a very tough man. He's a very smart man. He's a great leader for their country. He's a great leader. and I have a great relationship with him. I think we'll get it set.
That conversation up next with John Lieber of Eurasia Group, live from New York City this morning. Good morning. Bank earnings season almost upon us. Your week ahead looks like this. Tons through Tuesday and Wednesday. Tuesday, JP Morgan, Goldman City, Wells. Wednesday, Bank of America and Morgan Stanley. Into this, a market is bouncing back. Equity futures on the S&P 500 higher following the biggest one-day loss since April on Friday. Equity futures this morning higher by 1.3% on the S&P. On the Nasdaq, up by 1.8%. Max Kettner of HSBC, the big bull, just publishing moments ago. We think renewed tariff woes create another buying opportunity.
And other people seem to agree, as you can see from the market reaction. And clearly that's been the tone that we've heard in a lot of different notes, because guess what? Everyone thinks that there's going to be a resolution. Everyone thinks that ultimately this will go back to the same place that it was before, which is money printer going to go,
It's the top story for markets worldwide. Not that, but trade. Under surveillance this morning, attempting to de-escalate.
I think we're going to be fine with China. Look, I have a great relationship with President Xi. He's a very tough man. He's a very smart man. He's a great leader for their country. He's a great leader. And I have a great relationship with him. I think we'll get it set. I know what happened. I really understand what happened. And I'm not even saying he's wrong. But then we met him with something much tougher than what he did to us.
So here's the latest this morning. The Trump administration signaling openness to a deal. President Trump saying President Xi just had a bad moment, threatening export curbs on rare earths. Bloomberg's Tyler Kendall joins us now for more. Good morning, Tyler.
Hey, John. Good morning. President Trump hinting here that there is an off-ramp, going on to tell reporters aboard Air Force One that November 1st, that effective date for a higher tariff rate, is an eternity away, in his words, signaling that there is this openness for a deal. Though worth mentioning that the White House maintains that that threat of an additional 100% levy on Chinese goods does remain on the table. Now, we did get a statement from China's Commerce Ministry yesterday, which said it is prepared to retaliate, of course, escalating that threat of a potential tit-for-tat trade war here, but went on to say that the threat of additional tariffs isn't the way to deal with Beijing. Of course, tensions flared last week when we saw China move to unveil these new export curbs on critical and rare earth minerals. And as you've been discussing, they really do have a grip on the global supply chain. They accounted for about 70% of global rare earth supply last year alone. Now, President Trump himself has also said that there could be some export controls when it comes to U.S. software exports, as well as threatened to halt certain aircraft parts supplies. But I would say at the moment, the most immediate impact seems to be that it is throwing that planned meeting between President Trump and Chinese President Xi Jinping potentially into flux. They're set to meet at the end of this month on the sidelines of the APEC summit in South Korea. And John, of course, critical and rare earth minerals are supposed to be at the top of that agenda list for the two leaders to discuss. But I will also point out that the White House has repeatedly said that soybeans will also be at the top of that list. And I bring it up because new data out this morning says that China's imports of soybeans reached a record high last month, but that did not include any U.S. supplies.
That right there is a sore point, that's for sure. Tyler, thank you. Tyler Kendall down in Washington, D.C. With us for more, John Lieber of Eurasia Group. John, welcome to the programme, sir. Welcome back, as always. John, do you see this as positioning to negotiate or actually setting policy?
I mean, the Americans and the Chinese set a policy that each other didn't like, and you got a round of retaliation from both, and now they'll back off. And I think Trump's messaging this weekend was pretty clear that he does not want to see this spiral out of control. He says these very nice things about Xi Jinping because he wants to meet with him. And what we see is that both sides, the leaders, are really committed to this path of de-escalation and this path of getting together at this APEC meeting, which, as Trump said, November 1 is an eternity from now in Trump time. And what's going to happen is they'll negotiate their way to calm down and make that meeting happen. And we think the path here is going to be de-escalatory going forward.
What can we say out of this meeting then? Who holds the leverage going in?
Yeah, it's interesting. I mean, I think genuinely both sides seem to think they hold the leverage. The Chinese clearly have figured out this choke point that can really hurt the American military by denying them access to certain types of rare earth exports. And you see how sensitive that choke point is with the over-the-top response from President Trump on Friday, threatening 100% tariff, threatening cut off airplane parts, and threatening to figure out other things they can do we don't even know about yet. So I think the Chinese have definitely hit a nerve here. And when it comes to the rare earths, clearly have the leverage to hurt the Americans, and also, frankly, seem a little bit more prepared to weather the storm of a long trade war. We have to remember, of course, that Trump, the original taco trade was Trump backing off of the Liberation Day China tariffs. And, I think that does suggest the U.S. can only withstand so much pain here. So I would say the Chinese have the advantage, but the Trump administration can can punch back pretty hard.
Is it really taco? I was reminded over the weekend what Ethan Harris said in the summer, which is Trump always tries again. We do have higher tariff levels, much higher than we had a year ago. Is this him just trying again on trying to get a better deal with China?
Well, you kind of have to hand it to Trump. He did sneakily slide in this massive, 5 or 6x increase in the average effective tariff rate for the United States, and the S&P is at all-time highs. So he has done what he said he was going to do by increasing tariff rates to around 15%. But he's clearly not willing to do the things that will cause the most pain to the U.S. economy. And in that sense, I think the Chinese know that they have a bit more leverage because he tends to respond with these threats that are a little bit outsized relative to what he's actually able to deliver on.
So this is interesting, John, because we had Peter Tchir on earlier saying this time is different, and it feels different because it's initiated by China, and you have the capital markets increasingly moving towards supporting this idea of a greater degree of domestic reliance on rare earths minerals. Are you saying that we're not there yet, and that essentially it can't be that different, and there has to be the heat taken down because right now the U.S. economy can't keep going without the products from China?
Well, it's not, the U.S. economy is affected. Yes, absolutely. I think over time, what you're going to see is companies innovate their way around this choke point the Chinese have discovered around rare earths so that they aren't reliant on China for them. But the real sensitive piece for the United States is how incredibly dependent their military supply chain is on these Chinese rare earths. And that is the important factor for Donald Trump and why he cannot tolerate the list of restrictions that the Chinese put out last week. Now, I think it's important to put the Chinese restrictions in context here. The U.S. just 2 weeks ago expanded their own export controls to affect a wide range of new Chinese companies that are now not allowed to get access to certain U.S. technologies. The Chinese, in our view, thought they were just retaliating proportionally to that. The Americans saw the Chinese retaliation as an escalation, and that's why we are where we are today. But it's the military that's the sensitive issue, not the U.S. economy when it comes to these rare earths.
As President Trump deals with a lot of international issues, I'm just wondering how it complicates the issue that the U.S. government is closed, that it's shuttered, and that there still isn't necessarily a sense or a path for how it can get reopened.
Yeah, good question. And I think one of the fascinating things here is how it seems to make no difference whatsoever that the U.S. is closed down. They did release their latest rounds of export controls. The U.S. did right before the shutdown began. So maybe you think that was because they were hurrying to get out the door. I don't know. I don't really think that complicates the fixing this issue that much, though. There's been an enormous, majority of federal workers right now are still on the job because they've been deemed essential. And there's just been, the Trump administration is taking very broad discretion in what people can do. The workers just can't get paid for it, but that's a problem if you're a federal worker, not if you're trying to enact policy.
Hey, John, I appreciate your time. As always, thank you, sir. John Lieber there of Eurasia Group. Friday was a very interesting stress test for this market and very different to the price action we saw back in April. If you think about what happened with the bond market, I know the bond market shut today for Columbus Day. Happy Columbus Day, particularly to the Italian community here in New York, which often celebrates that, including yourself, Annmarie. And I guess me too included. I'm on a little bit of a tangent here, forgive me. But the fact that the bond market rallied on Friday compared to what happened in April was a bit of a tell.
And it was the greatest rally that we've seen going back to August 1st when we got that payrolls report. So it gives you a sense of people looking more to a support, frankly, for the bond market rather than some sort of sell-off.
Equity futures this morning higher by 1.3%. Up next, the former senior U.S. intelligence official Norman Roule as the Israel-Hamas peace deal begins. Happy birthday to the bull market. a 3-year run. Anniversary was yesterday, October 12th, 2022. We've had an 80% plus move on the S&P 500 over that period, and we bounced back this morning. The rally resumes, up by 1.3% on the S&P. On the Nasdaq 100, up by 1.9. What a move, erasing some of Friday's losses. Thank you to Jessica Menton over in Bloomberg News for breaking down some of the numbers. $28 trillion in value added to this index over the past 3 years. Nvidia up by 1,500% over that period.
If you can remember, it goes back to when OpenAI was launched, the idea of ChatGPT, and suddenly it revolutionized the idea of exactly what artificial intelligence could do to the workforce. And suddenly you have seen those names absolutely skyrocket and continue with the gains. Yesterday, or on Friday, I should say, those were the ones that led things down. Those are the ones that are leading things up today as everyone tries to buy the dip.
Nvidia up by 3.4%. More on that story a little bit later as we count you down to the opening bell, 3 hours away with your morning movers. Let's cross back over to Yahira. Hey, Yahira.
Hi, John. We are seeing shares of U.S. rare earth miners climbing. MP Materials up 10.7%. USA Rare Earths also up after President Trump, of course, threatened a new 100% tariff on China, fueling trade tensions. It comes just as China tightened its grip on its critical minerals. So these domestic rare earth miners are rising on the idea that they'll benefit if China-U.S. trade tensions continue to escalate. And moving on to NVIDIA and AMD, also rebounding this morning. AMD up nearly 4%, NVIDIA up 3% after NVIDIA fell 5% on Friday, also related to President Trump's tariff threats. And these semiconductors, of course, are caught right in the middle of this trade spat. And amid the risk-off mood on Friday, most major cryptocurrencies, including Bitcoin, fell. That made stocks like Robinhood fall on Friday as well. But we are seeing a rebound now in the pre-market up 3.7%. John?
Yahira, thank you. Thanks for the update. More from Yahira later this hour. On our radar this morning, President Donald Trump softening his stance to the US-China trade standoff after threatening a 100% tariff on imports. The president posting on Truth Social, "Don't worry about China. It will all be fine." Elsewhere, Vice President J.D. Vance warning that painful job cuts are coming if the government shutdown is not resolved. Vance telling Fox News the longer the standoff continues, the deeper the cuts will be. And finally, all remaining living Israeli hostages have been freed from Gaza under a US-brokered peace deal. The ceasefire, including a swap for nearly 2,000 jailed Palestinians. President Trump is in Israel and is set to address Parliament over the last 30 minutes or so.
Absolutely historic moment. And the president, when he addresses the Knesset, is going to say, this is the historic dawn of a new Middle East. Not only do we have the remaining living hostages back in Israel, you do have hundreds of Palestinians from the West Bank now also being released. On top of that, he's going to go on to an unprecedented peace summit in Egypt. And that is really going to cement potentially what the next phase of the ceasefire, this agreement, could mean.
Let's head over to Jerusalem and catch up with Bloomberg's Ollie Krug. Ollie, the Israeli leader speaking right now in the Knesset, the President, Donald Trump, about to speak in just a moment. Just frame this moment for us, how important it is for the people of the region and ultimately also for the leadership of these two individuals.
Yeah, Jonathan, it's hard to actually put into words the sort of significance of this moment for the Israeli people who, since the beginning of the war on October 7th, more than 2 years so now, have been awaiting the return of the hostages who, as of this moment, are no longer in Hamas custody, which really, no matter what happens next for the Israelis, is the end of one of the most bitter parts of what has been one of the darkest chapters, really, in Israeli history, certainly in modern Israeli history. And I think it's summarized in some ways in some of what we heard from the Speaker of the Knesset speaking a little bit earlier, introducing President Trump. The thank yous all around from Trump, from the team. We were hearing chants, Trump, Trump, Trump throughout the parliament. But he's saying that basically the American president, Donald Trump, is not going to be remembered just as an American president, but as a giant of Jewish history and will be remembered 1,000 years from now. So that is sort of the emotion and sort of the sentiment that is being felt by the Israelis. I mean, Donald Trump is easily the most popular person in Israel right now. That is evidenced even before you land in Israel. When I arrived a couple days ago, looking out the window of the plane, you see a skyscraper, Israeli flag, American flag, underneath thank you. You get on the road to drive from Tel Aviv to Jerusalem. These are roads that are lined with Israeli flags. Every third flag as of Friday night is an American flag, and that is very much the sentiment among the Israelis here. Within the parliament, of course, Benjamin Netanyahu got a massive applause as well. But the sort of legacy for Benjamin Netanyahu and the broader picture for Benjamin Netanyahu is much more complicated. He, yes, has gotten a boost in popularity, having managed to sort of broker this deal alongside Donald Trump. But you saw it from Steve Witkoff speaking in Hostage Square a couple of days ago before literally hundreds of thousands of people. Every time Trump's name came up, chants of cheering for Trump, Trump, Trump. Benjamin Netanyahu names came up, it was booing across the board. Now, we should say that is a specific subset of the Israeli population, but that is sort of broadly speaking what these two leaders are looking at today as we wait to hear from the President of the United States speaking before the Knesset, the first American president to do so since 2008 under George W. Bush.
Ollie, thank you. Stay close, of course. Ollie Crook there in Jerusalem. Building on this historic story, Norman Roule, the former senior US intelligence official, writing the following: the Middle East continues to pose many challenges, but the president's approach reshuffled the strategic deck, offering opportunities and leaving the US the undisputed major power in the region. Norm joins us now for more. Norm, Witkoff, Kushner, the President of the United States. Norm, what made a difference here?
Well, we've got a president who spent the first 10 months of his administration developing a new policy for the Middle East, a policy that focused on constraining Iran's nuclear program, Iran's proxies, providing Israel with unalloyed support, but also building very strong relations with a variety of Arab partners, resetting relations with Saudi Arabia, the United Arab Emirates, but also maintaining strong relations with Qatar and ensuring strong relations with Turkey and Egypt. And together, this provided an architecture that enabled the Trump administration to speak with pretty much everyone that needed to be brought to the table, but also to provide pressure on all of those parties through those channels. And then he used unorthodox approaches, Mr. Witkoff and Mr. Kushner. And I have dealt with Mr. Kushner in the past, and he's a very sober and hardworking individual. And we've seen extraordinary results. We should not understate the tectonic nature of this moment.
Norm, was it the strategy behind this Trump team that really changed it? We spoke to Amos Hochstein on Friday, who was an individual that worked under Biden, and said this deal was on the table in January. What's changed in the 9 months?
Well, aspects of this deal were always going to be on the table. I mean, the idea that there would be a prisoner exchange, of a release of Palestinian prisoners, the release of hostages, that there would be some sort of a disarmament of Hamas, that was going to be true no matter what administration was going to be in power. But the idea that you would bring pressure upon the parties to make this happen, I don't think that was going to be achievable in the Biden administration because of the nature of their relationship with the players in the region. And the Trump administration had a very different approach, and that approach made this happen. So we should be clear, the Biden administration's approach to the region was unlikely to achieve this result, and the Trump administration did this in 10 months.
Norm, when it comes to what comes next, there's going to be this unprecedented peace conference in Egypt. What do you expect that will come of that? Will we get more information on what phase 2 looks like when it comes to Gaza?
This is an extraordinary conference. In and of itself, this is unusual. 20 nations, the president of Indonesia is showing up. You've got 20 nations dealing with Mahmoud Abbas, who has not been to Israel in some time. You've got the Prime Minister of Egypt, who has been invited and may show up nonetheless at the end of this important holiday. If that happens, that would be the first time he has been in Egypt in quite a while. If the Israeli Prime Minister attends, that would be the first time he would be meeting with some of these countries. And remember, there are countries attending this that do not have relations with with Israel. And this would be the Israeli prime minister attending with President Mahmoud Abbas, someone he has refused to recognize. So this would be an opportunity for Netanyahu and Abbas to, in essence, set the stage for that second effort, that second phase. Also for these countries to identify what support they're going to provide, and for the president to pull them together and start that process. And it is critical that this security, that this aid be put in place to provide the Palestinian people with the humanitarian and security architecture they need to restore their lives.
Norman, just to that point, you were talking about whether Bibi Netanyahu, the prime minister of Israel, will be going. His office said this morning, he thanked President Trump for the invitation, but said he won't be able to attend due to the beginning of the Jewish holiday this evening. So we'll see whether he eventually makes it there. But right now, it doesn't seem like it's the case. And I'm just wondering, if you parse this out, is this coalescing of powers in the region going to be helpful to bringing Israel back into the international fold? Or is Israel still the odd man out? Is it going to take a lot for them to regain some of their previous reputation?
Well, again, we'll see how long the conference lasts. And if at the end of the holidays the prime minister is able to attend, we need to see what the prime minister's politics are like if the hard right becomes a problem, which prevents him from participating as well, because he would be meeting with Abbas. He would have to make some concessions. He has stated no Palestinian Authority in the West Bank, so that's or in Gaza. That's going to be a problem. But we've got a situation where the Israelis are now not going to be responsible for security or some of the reconstitution of governance in Gaza. The Palestinians will be doing this. Will Hamas be responsible for the problems of Gaza or the Palestinian Authority? Or it's no longer Israel's responsibility. It's now a Palestinian issue and an international issue. So in essence, the blame shifts from it's an Israeli problem to an international problem. But again, we must get humanitarian aid, security aid, and rebuild the lives for the Palestinian people. So I think before we get to that political problem, this is a humanitarian and a security issue, and that's where the emphasis will remain at this point.
Norm, I wonder if there's a broader conclusion also, because we used to see that the alliance between Western nations used to be the United States, Europe, and a couple of others, maybe Japan. Now it seems to be really shifting to the Middle East. How much has this deal and the U.S.'s relationship with Saudi Arabia in particular really solidified that idea?
Well, you've seen several things. So first of all, this wouldn't have happened had the United States not worked with Egypt, Qatar, and even Turkey. Certainly that's true. However, there have been months of intensive diplomatic conversations with Saudi Arabia and the United Arab Emirates, and Saudi Arabia working with France and other countries that in essence created an architecture that also made this happen outside of the United States itself. And that Saudi Emirati and diplomatic pressure was itself a dynamic that cannot be ignored. So these capitals, these rising powers are something that need to be recognized and worked with. And the Trump administration, to its credit, did exactly that over the last 10 months, and we're seeing the results. So ranging from the chip deals that the Trump administration is putting together, the energy discussions, and now we're seeing this in the Middle East. It's a very interesting and dynamic approach.
Norman, appreciate your perspective on quite an important moment in that region. Norman Roule there of CSIS, and what could be a crowning moment for the president's leadership for years still to come. And we hope this is an enduring peace in that region. I imagine there's still doubts. The president is about to address the Israeli parliament. The White House pre-released some of the remarks he will make. The Holy Land is now finally at peace. A beautiful, brighter future appears suddenly within reach.
Absolutely. The president is talking about a new dawn in the Middle East. Almost echoes what he said as well in Riyadh, but this is just him in this crowning moment. And it really is, even though there's so many question marks about what comes next when it comes to the different phases of this peace plan, the fact that the living hostages are home, the fact that the remains of those that died in captivity are coming back to Israel, you have hundreds of Palestinian prisoners leaving the West Bank, and the president is going to sit down with Arab leaders in Egypt to talk about what's going to happen with Gaza, and potentially, to Norm's point, potentially Bibi Netanyahu will show up at the end of this holiday. This is unprecedented, and it's historic for the region.
We'll be tracking these events as they play out over the next few days, of course, right here on Bloomberg TV and on Bloomberg Radio. Historic week, potentially. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Let's cross over to Yahara for more. Hey, Yahara.
Hi, John. French President Emmanuel Macron announced a new cabinet as pressure mounts for the government to pass a budget. On Friday, Macron reappointed Prime Minister Sébastien Lecornu just days after he had resigned. Macron's weakened majority and a widening budget gap are fueling investor concerns, with French bond spreads now at multi-year highs. Meanwhile, the Pentagon is looking to buy as much as $1 billion of critical minerals. The Financial Times reporting the purchase increase follows China's Ministry of Commerce putting new export controls on rare earths and other materials for defense and technology manufacturing. The Pentagon's Defense Logistics Agency stockpiles were valued at $1.3 billion as of 2023. And Warner Brothers Discovery has rejected Paramount Skydance's initial takeover offer. Sources telling us here at Bloomberg, Warner thought the offer of around $20 a share was too low. Warner CEO David Zaslav is said to believe the company's streaming and studios arm will command a premium next year once it splits from its cable assets. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate the update. Up next on the program, US dollar dominance in question.
The dollar's role as the key financial currency in the world has really changed in the last 12 months. And so I think this is just a cyclical adjustment after something like a 10-year dollar rally.
Up next, we'll catch up with Sonja Marten of DZ Bank, live from New York City. You're watching Bloomberg TV. Stocks are bouncing back. We're up by 1.2% on the S&P 500, on the Nasdaq 100, up by 1.8%. Blackout period for the Federal Reserve begins this weekend. That's come about so quickly. That Fed meeting 2 weeks away. Chairman Powell speaks tomorrow. Ton of Fed governors as well get the final word in before things go quiet.
I'm laughing because they get the final word in without data. So ultimately, how good is that word if they're data dependent? It really creates this sort of chicken and egg. How much do we listen to it? How much does it matter? What are they actually looking at? I don't know. Is it a quiet period for them, or is it a quiet period for all of us without the data that we're getting from the government?
I thought there was some tension in the Fed minutes.
Yes.
A lot of them assume they're going to cut rates again, but the majority also believe that risk to inflation are skewed to the upside. Make that work.
No, I can't. Sorry. I mean, that's essentially what we're dealing with. And how much is this non-voting members that are sort of the quiet dissenters on the sideline, and the voting members that actually are pushing the mainstream, saying we need to cut again?
We were supposed to get US CPI later this week. Of course, that's delayed because of the government shutdown. October 24th is the new date on the calendar for that data point. Under surveillance this morning, US dollar dominance in question.
The dollar's role as the key financial currency in the world has really changed in the last 12 months. I think that what we're seeing is primarily a cyclical development and not this big structural, like the whole world is boycotting the dollar or something like that. I think that the dollar's decline, it's still overvalued against most of the G10 currencies. And so I think this is just a cyclical adjustment after something like a 10-year dollar rally.
So here's the latest this morning. US dollar facing fresh volatility as US-China trade tensions ramp up. Sonja Marten of DZ Bank writing, while it is certainly easy to take a negative stance on the US dollar, given the situation in the US, many investors continue to invest capital right here in the United States. Sonja joins us now for more. Sonja, let's just compare and contrast the price action of April to the price action of, say, Friday, and the price action of more recent days. Sonja, back in April, we were worried about the loss of exceptionalism. Are we sitting here now looking to close out October, thinking about the lack of alternatives?
Yes, absolutely. I mean, as we said before, I mean, in April, we had this huge move in the treasury market, in the dollar. A lot of people were very concerned about the future of the dollar. As just mentioned in the program earlier, there was a lot of discussion, and we had some discussions, I remember, about the possibility that there might be a broader loss of confidence in the U.S. currency, in the U.S. equity market, in the U.S. market in general. And I think that really drove the story for a while in the spring and early summer. And, now we see the reaction on Friday. The dollar was very muted. Treasury yields went down. And I think what we've seen is a growing realization that for many investors, there aren't that many alternatives to the U.S. market. And as we see in the data, the demand for dollar asset has remained really high throughout the end of July. So that already includes, 6 months of Donald Trump as president.
Euro dollar, we were building up some big longs in a single currency, Sonja. Euro dollar's broken back down to 115.86. Do you believe we still need to let some air out of that particular trade?
Well, yes, I do. I will say, though, that to a certain extent, we are flying blind right now because we have no fresh data from the IMM on speculative market positioning. That's one of the data points we are not getting as a result of the shutdown. The 23rd of September, the outstanding amount of Eurodollar longs was still massive, over 100,000 contracts. We don't know how many of these have been unwound, but I'd be surprised if all of these were already out of the market. And I think, particularly with the view to France, there is certainly some additional downside risks into Eurodollar in the very short term.
So do you say that right now is a good time to get dollar long?
Well, I think definitely if you're looking at a very, very short-term view, that might be the case. But ultimately, I think as a medium or longer-term investor, levels below 116 are certainly attractive as a buying opportunity for Eurodollar.
I just wonder how difficult it is to really use past models for this market. I'm looking, for example, at the dollar. Yes, it has seen a bit of strengthening over the past couple of weeks, but you look at gold, it's reaching a new all-time high. You look at silver, reaching an all-new time high. This idea that this is a market that is increasingly based on real assets and not the financialization of the idea that a lot of people have bought into over the past couple of decades. Is there something fundamentally different this time around when it comes to valuing currency markets?
I definitely agree with that. I think we have been in that situation for some time. You think about, COVID, the war in the Ukraine, the inflation push we had. I mean, all of that has fundamentally changed the way things work. I mean, for people like us who've been in this market for a long time, and we've had to rethink and relearn many things. And I think certainly when you talk about model-based approaches, I would argue that most of these simply do not work anymore. And we have to think with a much more open mind, and we have to think as well much more in scenarios, because things keep happening, particularly this year, that we would not have thought possible, not only in the US, but particularly obviously in the US. And, we've just seen a renewed escalation of the trade war between the US and China. And, it's very difficult to predict exactly what's going to happen. Is it going to be TACO, or is it going to be, I heard this morning on your program that Trump tries again or something like that. So we'll have to see how that plays out. But basically, model-based approaches don't really work in that environment anymore.
Sonja, Trump always tries again.
That's what it was.
So when it comes to that, and you have this potential escalation of the trade war brewing, do you think that's dollar positive? Investors just want to go to the haven?
Well, I think, so that obviously depends on what happens elsewhere in the world. I mean, when Trump became president and we thought about what would happen if Trump started raising higher tariffs, and to be honest, we didn't expect that to happen as early and aggressively as it did. The thinking was that this could actually be dollar positive because these tariffs would have a considerable negative impact, not only in the US, but also, of course, on other economies, and that this would ultimately allow the dollar to gain some ground. Now, I think that idea has largely been dismissed in recent months, but it's still somewhere there. So it always depends on what happens to the other side. I mean, when you look at Europe, for example, we have a trade deal. We'll see how long it lasts or when it will be changed. But the fact of the matter is that this trade deal has a negative impact on growth in the Eurozone, and therefore it may be dollar positive in some ways, but it certainly is euro negative in other ways. So I think that's something that we have to always think about this from both sides of the equation. There isn't a straightforward answer to that question.
Dollar stronger so far this morning. Sonja, thanks for jumping on. Sonja Marten there of DZ Bank. Sonja was talking about flying blind. It's interesting that at the end of this month when the Fed gets together, we might have CPI, might not have payrolls, at a time when the Fed is putting emphasis on one and not the other. And the one that they're not putting emphasis on is the one we might have. And it could be uncomfortable. It could have a 3 handle. That makes things difficult for this Fed, I think.
Or does it allow them to say, well, actually, it's probably a negative payrolls report that we would have gotten, which is what we heard from Chris Waller. So we have to look past this and trust that this is simply a transitory type of inflationary push. But you are absolutely right. It is really an odd kind of confluence of events.
Working up to that Fed meeting about 2 weeks away. Coming up next, we'll catch up with Calvasina of RBC, Henrietta Treyz of Veda Partners. We'll speak to the former senior White House trade official, Kellyanne Shaw, and Ian Harnett of Absolute Strategy from New York City. The second hour of Bloomberg Surveillance is just around the corner.
In the absence of data, people seem to be perfectly happy.
We're definitely dealing with less information, but we're not flying blind.
The earnings reports are real. That's our data.
The Fed is likely to cut. The economy is likely to grow.
I think they would err on the side of caution.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning. Good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now. In the absence of data, you put even more emphasis on the earnings. It's a big week for bank earnings. Check out the calendar. JP Morgan, Goldman, Bank of America, Citi, Wells Fargo, all reporting Tuesday through Wednesday. You'll hear from Chairman Powell as well. There's a lot still to play for. Equity futures bouncing back already this Monday morning from Friday's losses. Futures up by 1.3% on the S&P, on the Nasdaq up by 1.8% as the president dials down the volume, takes down the temperature with China over the weekend.
And it's frankly what a lot of people were almost hoping for and expecting, and that is the reason why you see the buy the dip mentality come back. And you do see that from Max Kettner as well. Even Mike Wilson, who talks about the potential for 11% drawdown in the S&P 500 should the tensions continue, said that the expectation is for that all to be bought back with a positive kind of tilt because likely there will be some sort of resolution. So what if this time is different? That, I think, is quite a different scenario that this market has yet to grapple with.
Monday morning, the mood music is different. I've got all of that, but the direction of travel, the lyrics are still the same. Check out MP Materials right now in the pre-market, 10% move. Look at the reporting from the Financial Times in the last 24 hours. The Pentagon, stockpiling, critical rare earth minerals. That's going to be the big effort over at the Defense Department. And then JP Morgan coming out this morning, right on time. Jamie Dimon promising to help finance this massive effort to improve national security.
It feels like a whole of government, a whole of industry approach across the United States when it comes to the fact that the U.S. needs to fortify and shore up the access, the raw materials when it comes to rare earths, because China owns the entire supply chain, from owning them, refining them, processing them, and selling them. And it's not just about AI technology, which we talk a lot about this program because that's what it means for the stock market. It is about our national defense and the fact that there are pounds of these rare materials in almost every single one of U.S. weaponry.
You can say what you want on social media on Air Force One. The Chinese can say whatever they want at the end of this month, the start of November, when these two leaders meet. Ultimately, the effort will not change. There needs to be an increase of domestic production on several fronts. JP Morgan wants to finance it. We know where this is going.
And this is the reason why it's sort of an interesting moment. Do both sides have the incentive to de-escalate, right? Who is willing to take more pain to decouple more suddenly versus gradually over a certain time period, which seemed to be the initial effort, right? Let's take a while to actually get access so that we can wean ourselves off them and then create our own. And that, as we were talking about earlier, is part of what China's responding to, saying, just hold on a second. We can tolerate the pain. We don't want your chips. And guess what? We'll develop them in short order.
Stocks are up by 1.2% on the S&P, just eating into some of the losses from Friday's session. A broad-based rally on the S&P 500, on the Nasdaq too. Coming up this hour, Calvasina of RBC Capital Markets looking ahead to earnings. Henrietta Treyz of Veda Partners as the US government shutdown enters its third week. And Ian Harnett of Absolute Strategy warning the AI capex endgame is approaching. We begin this hour with stocks rebounding following their biggest one-day drop since April. Calvasina of RBC writing the following. If the strong sentiment around earnings that was seen in the last reporting season can't be maintained, we think it will be difficult for the major indices to avoid a period of digestion. Laurie joins us now for more. Laurie, welcome back. I give you a ton of credit because I think you've been so consistent for so long on this point. Don't completely ignore the trade story. At some point, it's coming back and it will bite. How are you thinking about that going into earnings season?
Well, thanks, John. Thanks for having me as always. And look, it's interesting, John. I've been, kind of all over the last couple of weeks, London, running around the U.S. to a whole bunch of different cities and states. And the one thing that I was not hearing from investors that they were worried about was a re-escalation of China trade issues. And I think that's really interesting that is what really finally gave this market a bit of a scare on Friday. It really proved, one, that this was not on the radar of investors, and two, that tariffs do still have this, sort of power, and maybe there's been a bit of complacency on those trade issues. I think as we go into earnings, frankly, this has been an earnings-driven market. We haven't seen any multiple expansion in the S&P 500, the NASDAQ 100, or even the top 10 names in the S&P 500 since August. That's not to be, that's something to be expected, frankly, when inflation is moving up. And so I think this market is really going to get its mojo going forward from earnings. And unfortunately, to me, it just feels like we're in the middle of a little bit of a fade right now.
So, Laurie, let's talk about the earnings and what we've heard so far. We've had a massive step down in payrolls growth, got that. But ultimately, this is the Delta Airlines economy. Half the country thinks they're Group 1. Now, Laurie, when you have a situation like that, do you just assume the earnings hold up?
So I think what's been holding up the earnings, right, I do think that to some extent it's been these higher income consumers, if you look at some of the consumer companies or companies like the airlines. But I think also we've seen big tech propping up this market from an earnings perspective, those mega cap names. And frankly, when we look at the rate of upward revisions, a good barometer for earnings sentiment across different indexes and sectors, it's been the top 10 names in the S&P 500 that are holding up well. And it's been the tech sector itself, to a lesser degree, financials and healthcare. But really, we've already started to see weakness emerge in some of those tariff-related sectors, the consumer-related sectors. And as we think right now, I do think that what benefits these bigger cap names in the S&P, that can keep earnings afloat. But frankly, we do wonder if we're starting to get to peak levels of sentiment there as well.
Laurie, I do wonder if there is something structural underway. I mean, we were talking with Peter Tchir earlier of Academy Securities, and he was saying this is actually opening up opportunities to invest longer term in parts of the economy that will benefit from a decoupling between China and the U.S. I mean, moving past this moment and the idea of the volatility, do you agree that things like the Russell 2000 potentially could see upside if there is more of a push to increase the domestic supply chain? If some of these other companies as well stand to benefit from the likes of J.P. Morgan, from the likes of Apollo, making bigger investments?
So I think it goes back, when you're talking about small caps specifically, Lisa, I think it goes back to what's your view of the economy. And I would differentiate between upside and outperformance, because this has been a big debate on Wall Street over the last couple of months, frankly, where we've had a lot of people coming out and saying, you want to buy the Russell 2000. That's really been more about rate cuts than anything else. I think that catalyst has passed for now. But what we've told people is that if you're looking for the start of a bigger, longer term outperformance cycle in the Russell 2000, i.e. leading versus NASDAQ, leading versus the S&P, not just going up, that you really need to get a hot economy or a broken economy in your mindset. So what do I mean by that? Typically, you want to buy small caps when you break the economy, you own them for the springboard coming out, or you need an economy that's more like a 3% economy than a 1% to 2% economy. You want ISM manufacturing moving up. You want jobs growth reaccelerating. If you can get there on that macro data for that kind of ramp up, that really, really hot backdrop, then sure, go ahead and buy small caps. But that's not what I'm hearing from the economics community at large right now, or our in-house team. So we've been a little bit cooler there.
Based on what you hear from companies so far, and I realize that earnings season really officially kicks off tomorrow with the likes of J.P. Morgan and Goldman Sachs reporting earnings, I'm just wondering how resilient do you think that corporate America is to some additional ratcheting up of trade tensions, particularly between the U.S. and China, even if it does cool in the near term, that this is going to be an ongoing story about the ramping up, ramping down, but continually toward the same destination?
Well, look, I think if we go back to the beginning of the year when tariffs were being discussed as a policy initiative, we heard a lot about short-term pain for long-term gain. And I think that somewhere over the summer, equity investors just forgot about the idea that there might be some short-term pain involved. So if you look at, kind of the question of resiliency, I think that corporate America is doing a fantastic job. That being said, I don't think that they are able to completely get out of this without some bumps and bruises. And frankly, Lisa, we saw some of those bumps and bruises in the last reporting season. If you looked at the industrial sector, for example, and this was the one that really got creamed during the first trade war of 2018, it's held up better this time around, but it's an extraordinarily expensive sector. And when we were seeing companies that were coming out and beating, we weren't getting the big pops that you would normally expect to see. If you look at margin expectations using consensus data for both 2Q and 3Q, which is more of a forward look, we saw between June and Labor Day, we basically saw all the tariff-related sectors take a hit, have those margin expectations trimmed. We saw it for the healthcare sector, we saw it materials, we saw it for industrials, and we also saw it in 3Q for consumer discretionary. The reason nobody noticed is that S&P 500 margin expectations stayed flat, and that was because the tech sector went up in both time periods. So I think that you've already started to see some of those bumps and bruises emerge. Nobody noticed, though, because the tech sector was making everything look good at the broader index level.
Laura, you mentioned trade during Trump's first administration. How are clients viewing the Chinese negotiations this time around?
It's a great question, Annmarie. And, it's funny. I mean, there were two things that we didn't really talk about over the last 3 weeks in my investor meetings. One was the government shutdown, and one was the trade relationship with China. We talked about AI. We talked about valuation. We talked about labor market weakness. We talked about how CapEx isn't coming through in the way people thought over the summer. And so I think that, to be honest, people thought that we were on the upswing and really had discounted the idea that we might be taking some steps back. I think the policy experts, in the financial community and down in D.C., I suspect that many of them were not surprised by this, but I do think equity investors, it just wasn't on their radar.
Laurie, appreciate you jumping on this morning and breaking it down. Looking forward to earnings season. Laurie Calvasina of RBC. A lot of people had moved on, and then it came back to bite on Friday, and we'll see if that's just a scare or something more enduring. We're hearing from the Treasury Secretary, Scott Bessent, speaking to the American press earlier on this morning. We won't let China export restrictions go on. This is China versus the rest of the world. We expect support from Europe and India to take on China on this issue.
It sounds like he's amping up the rhetoric, especially when you have a headline saying this is China versus the rest of the world, and we're not going to let Chinese restrictions go on. But at the same time, he's saying that he's optimistic that they can de-escalate, and he wants to meet with his counterpart. So this is, once again, the Trump administration having really a lot of scope in terms of how they want to negotiate with China. At the same time, I think as a Treasury Secretary speaking directly to the financial markets, saying we are still going to have this dialogue. I'm still going to meet my counterpart.
Equity futures pulling back just a little bit, positive now by about 1% on the S&P 500. With an update on stories worldwide, let's get your Bloomberg brief. We can catch up with Lizzie Burden with more. Hey, Lizzie.
Hey, John. President Donald Trump is speaking in the Israeli Knesset following the release of all 20 living Israeli hostages from Gaza. Under the terms of the deal, once all the hostages are freed, Israel will free almost 2,000 Palestinian prisoners and allow more aid into the Gaza Strip. Elsewhere, silver hit its highest level in decades as a short squeeze in London intensified. Concerns over the lack of liquidity here in London drove silver near $52.50 an ounce, a level not seen since 1980. Investor demand spreading to other precious metals, with gold surpassing $4,070 an ounce and platinum also surging. And Xiaomi shares fell the most since April after reports that one of its SU7 electric sedan's doors failed to open after a fiery crash in the southwest Chinese city of Chengdu, trapping at least one person inside. The crash added additional scrutiny to the safety of electronically operated car door handles. And that should be my brief, John.
Lizzie, thank you. Appreciate it. More from Lizzie later on this hour. Up next on the programme, a shutdown stalemate.
The longer this goes on, the deeper the cuts are going to be. Some of these cuts are going to be painful. This is not a situation that we relish. This is not something that we're looking forward to. But the Democrats have dealt us a pretty difficult set of cards.
That conversation up next with Henrietta Treyz of Veda Partners, live from New York City this morning. Good morning. Soothing words from the president over the weekend. The USA wants to help China not hurt it. Equities bounce back, up by 1% on the S&P 500. On the Nasdaq 100, up by 1.6%. Under surveillance this morning, a focus in Washington, D.C., the shutdown stalemate.
The tariffs have also given us a little bit of financial flexibility so that we can keep on as many essential services as possible, including, most importantly, paying the troops. The longer this goes on, the deeper the cuts are going to be. Some of these cuts are going to be painful. This is not a situation that we relish. This is not something that we're looking forward to. But the Democrats have dealt us a pretty difficult set of cards. We're trying to do the best that we can with the shutdown situation that Chuck Schumer has left us.
So here's the latest this morning. The government shutdown entering its third week as Democrats and Republicans remain deadlocked on Capitol Hill. Bloomberg's Tyler Kendall joins us now for more. Tyler, are we getting closer and closer to approaching those delicate moments where it gets difficult to continue this?
It appears that way, though, John. Really, neither side is budging on their position. Plus, keep in mind that the House is on recess this entire week and the Senate's not coming back until Tuesday. And both sides are really dug in, including this White House, which says that it's not going to negotiate with Democrats on any of the provisions related to health care until the government reopens. But as you're alluding to, the pressure is certainly mounting. Take these layoffs, for example, that you heard the vice president threaten are only going to get worse. They're already starting to be challenged in court. In fact, we're going to hear the first arguments in a case challenging the legality of these firings this Wednesday. So potentially we'll get an update there. But it was a court filing last week that we learned that the OMB sent letters to an estimated 4,100 federal workers across 7 agencies saying that their positions are going to be terminated. Well, that is going to be a big pressure point. We saw at least one pressure point appear to be relieved over the weekend, and that's pay for our troops. President Trump announcing that the Pentagon had allocated funding that they could redirect to military pay. This is $8 billion in research funds that hadn't been used yet and is instead going to go towards paychecks. But John, we're going to have to keep watching this very closely because really at this point, as you mentioned, it's really a stalemate.
Tyler Kendall, down in the nation's capital in Washington, D.C. Tyler, thank you. Joining us now to extend the conversation, Henrietta Treyz of Veda Partners. Henrietta, a question I never thought I'd ask. What does the House Minority Leader Hakeem Jeffries have in common with Congresswoman Marjorie Taylor Greene?
Wow. Well, they both are at this juncture actually in the same place on extending ACA subsidies and the healthcare component. I think that is the reality that the Republicans are going to have to accept before the government is reopened, or at least before the end of the year. We've got 75% odds on the ACA subsidies being extended. And that's because 22 million Americans disproportionately in red states like Marjorie Taylor Greene's are going to lose their healthcare coverage. And going into a midterm election, no matter which side you're on, you don't want that. So eventually there will be a deal to extend the ACA subsidies. I think it's going to hitch a ride with a farmer's bailout, but we're not at that pain point yet.
I don't really hear a lot of people talking about farmers the same way they're talking about these ACA subsidies. How do you think both of these could be done to reopen the government together?
The timeline is really important, I think, Annmarie. We have to get through this potential Trump-Xi meeting. President Trump in the last couple of weeks has sort of quietly or less under the radar been promoting the idea that there's going to be a breakthrough that yields agriculture purchases by China of U.S. soy, which, of course, they have not purchased at all in the second half of this year. So the timing, and around November 7th, which is when they go on recess, which I know sounds ridiculous since they're already on break, or at least avoiding work, they do have a scheduled recess for Veterans Day. So what I see happening is that the Trump-Xi meeting in South Korea on the 31st and the 1st does not yield a breakthrough in soy purchases. And then we need the farmers' bailout. And that's because we're running out of time. And the farmers need something if we're not going to be able to sell into markets like the European Union or India, as you were mentioning before. That's not going to happen for political reasons there. So it's really the timing. And I'm just trying to forecast for our clients what this ultimate off-ramp is going to be. And the farmer bailout need is very real, although under discussed.
Henrietta, though, are you saying that you expect the government to remain shut until Trump potentially has this meeting at APEC with Xi Jinping?
I don't really see a problem forecasting that right now. There's no forward progress. There's no indication that the House is coming back into session at all this week or into next week. They don't really work Tuesday, Wednesday, and Thursday is the only period of any real work week that they do come in. So getting to November 1st is pretty easy. It's just a hop, skip, and a jump away.
Which raises this issue of what happens in that time. And we already have talked about the idea that troops are going to get paid with some of the funds getting redirected to the Pentagon in order to make sure that that happens. What else is going to happen like that? How much power does President Trump really have to do this in absence of any kind of direction whatsoever from Congress?
This is the most important question. The president is taxing U.S. citizens with tariffs, and now he's starting to spend that money. What the message from the vice president that was just relayed on that clip you just said is that the tariffs are going to pay for troop paychecks. That's not correct. That's wrong. The president doesn't have the authority to just pick up Treasury funds and start spending them. These are already allocated research and development packages that are $8 billion worth that they can spend over 2 years. That is a technical appropriation that Congress authorized that the president is diverting through the executive branch. It's not spending tariff revenue, but you're putting a spin on tariff revenue that makes it sound like it's a good thing. Like, hey, tariffs are paying for the troops. That's not correct. So the longer we get into this shutdown, the more the president is going to have an opportunity to say things like that. Are we paying the Coast Guard? They're not funded under the Pentagon. How exactly are we going to pay for those funds? It's all going to come from appropriated money. not from the president redirecting tariffs. And so that's going to be eventually a squeeze. And the president's putting out leaks in a whole bunch of places with WIC, eventually with food stamps. They need a farmer's bailout. They need that to come from Congress.
How much are both Republicans and Democrats secretly happy that President Trump is doing this? Because it gives them more time to negotiate if you do have troops continuing to get paid.
Yeah, nobody wants to see troops not get paid. It's never happened in history. Last time we shut down, we had an appropriation for the Pentagon. And so we didn't have to face that. I think it's ugly for everybody, but it does prolong the shutdown because now there's no urgency to act. That's why I can't see a clear delineation. We used to say, October 15th when staff gets paid, or the 24th and the 10th. And we've blown past those. And it's because there are other ways to plug the hole. We don't have a real deadline until November 7th that I can identify.
Well, the next pay cycle for the military is the end of the month. Is there enough in the Research and Development Fund to continue paying the troops from that fund?
There's a lot of ways to be inventive. There's $100 or so billion from the One Big Beautiful Bill that the Pentagon was authorized to spend. They could probably redirect some of that to troop pay and then backfill it later. There's a lot of ways to get creative. But my underlying point is it has to be already appropriated from Congress previously. They can maneuver at the edges for a little while, maybe even into mid-November, and then it starts to get painful.
Can they maneuver in terms of paying air traffic controllers? Because in 2019, that was the pressure point that actually changed trajectory of the shutdown.
Yeah, I mean, I would hope so. I've got to get on a flight tomorrow morning. But the real piece that I want to see is members have to go through the pain of going through TSA, going through the airport security.
Well, then they need to go to work, Henrietta. Speaker Johnson hasn't called them back. They're not working
they're
right
not
now.
Here. So they're not seeing it. That's right.
Henrietta, appreciate you jumping on. Henrietta Treyz there of Veda Partners. This was always going to be the pressure point, right? The airport's going to sound up.
To Henrietta's point, which is a great point, you need members of Congress to go through TSA. Well, they're back in their districts. Unless they're taking vacations, they're not going back to Washington, D.C., so maybe they don't actually know that yet. But wait till their constituents have to travel for business, for work, for pleasure, and then they're going to be the ones that are calling and saying, this is ridiculous. We need the shutdown to end.
Do members of Congress still get paid?
Do members of Congress still get paid? I believe they do.
They do.
Yeah, they do.
Maybe we should think about, changing that in the future.
You don't say. I mean, that's something that's been brought up
align
before.
Incentives.
Exactly. Yes, that's something that's been discussed extensively.
Airlines are doing okay.
Get paid first.
By the way, airlines doing okay. Delta Airlines. Those headlines that came out going into the weekend. Our customer is financially in a good spot. We're not seeing any pullback in demand.
Even in the economy seating. And air traffic controllers are pushing back, too. They're saying, just to set the record straight, and over the weekend there were a couple of articles talking about, it wasn't us that stopped the first shutdown. We come to work. It was a small amount. There's sort of this interesting jostling where people want to keep you flying at the same time that you actually are experiencing those delays. So try to square that circle, too. I mean, there's a lot of, politicking behind the scenes.
If you are just joining us, welcome to the programme. We have got a bounce back in the equity market. Equity futures firmer by 1 full percentage point on the S&P 500. You see this across the equity market, not just stateside, but worldwide, after a pullback on Friday triggered by what looked like an escalation between the US and China. Over the weekend, comments from J.D. Vance, the Vice President, and the President of the United States on Air Force One, as well as on social media, attempting to open the door to some kind of agreement with China at the end of this month, the start of November. Fact of the matter is, there is still tension over one critical issue, and it's Chinese rare earths. China started this, and they haven't backed off on that issue.
And J.D. Vance, the vice president, said over the weekend it's up to Beijing to, quote, choose the path of reason. You hear from the Treasury Secretary, and he's talking about the fact that we're not going to go at this alone. We're talking to India. We're talking to the Europeans in terms of how we can confront China on this issue. And on Friday, Lisa and I were talking about the fact that Germany actually said this is a huge problem for us, and we're going to need to deliberate with the European Union on how we are going to deal with China and the fact that they own the entire supply chain pretty much. We're talking about 70 to 95% of the critical minerals.
Europeans are finding out that sitting on the fence is not a sustainable position anymore. You've got to make a call. Coming up on this programme, the former senior White House trade advisor Kellyanne Shah on the prospects of a US-China trade deal. Plus, happening right now, President Donald Trump speaking to Israel's parliament after securing the release of all 20 remaining hostages in Gaza. Live from New York City this morning. Good morning to you all and welcome to the program as we count you down to the opening bell. Equity futures on the S&P 500 firmer, bouncing back by about 1% on the S&P 500. On the Nasdaq 100, up by 1.5%. On the Russell, we're up by about 1.3%. This is the bounce back you've been looking for in the equity market. On our radar this morning, though, one of our top stories, President Donald Trump speaking at Israel's Knesset. His speech following the release of all 20 remaining living Israeli hostages from Gaza. Let's take a listen.
Guy's central casting. Let's put him in a movie. Look at him. Great job. And my people loved working with you. Loved it. They worked so well together. But many of Iran's top terrorists, including nuclear scientists and commanders, have been extinguished from this earth. And with Operation Midnight Hammer, boy, that's a great name for that, what we did. Last June, the United States military flew 7 of those beautiful B-2 bombers. They look so beautiful all of a sudden. They were always... I thought they were pretty planes. I had no idea they could do what they did. In fact, we just ordered 28 more of them. A little updated version. We ordered a whole pile of them. And almost 100 other planes went with them, including fighter jets. And we had 52 tankers, big, beautiful, brand new tankers that were loading them up 4 or 5 times. They've traveled 37 hours back and forth, think of that. But we had tankers all over the sky for all the other planes. We had the F-22s, the F-35s, F-16s. We had a hell of a lot of planes. So we had 52 gas stations in the sky. That's what they call them. I'll tell you, I wouldn't want to be flying one of them. We have our great General Raisin Cain right here. General, stand up. This guy, what a general. Thank you. I asked General Cain, I said, you know, we're having problems with ISIS, and I was in Washington, and I asked, how long would it take to defeat ISIS? And my Washington generals told me, 3, 4, maybe 5 years, sir. I said, I don't get it. We got the best equipment in the world. Why? So I flew to Iraq, and I met with a man named Cain. He said, what's your first name? He said, they call me Raisin, sir. I said, wait a minute, your name is Raisin Cain? I've been looking for you for a long time. You gotta be kidding. So they told me 3, 4, 5 years to defeat ISIS. And I sit down with him and I say, why is it? I flew there in the dark of night. I landed, I'll never forget it. It was quite a trip. I'm glad I made it because I met him. I said, could I ask you, General? I come down. He said with another general and a sergeant. Everybody was like central casting. They could go into a movie right now. Between him and you guys over here, we could get rich making movies, okay? And they got along so great. That's the beautiful thing, that your military and our military, Bibi, got along so great. But I was told by the television generals in Washington, we have the best equipment in the world. Why is it taking so long? And they said, 4 years. I said, so let me ask you, Raisin, how long would it take you to defeat ISIS? Sir, we can do it in 3 weeks, but you'll probably have some time left over. I said, you got to be kidding. What the hell are you talking about? They said 4 years. I said, well, sir, look, it's not my place to say, but you're asking me the question. What you have to do is you hit him from the west, you hit him from the north, you hit him from the south, you hit him above, you hit him below. I said, so why didn't they do it? And he didn't want to speak badly of his superiors, which is hard to believe they were his superiors. Should have been the other way around a long time ago, because he's the one that did Operation Hammer. It was flawless. It was flawless. It was absolutely flawless. And I said, so you really think you can do it in 4 weeks? Yes, sir, 100%. You have to do it differently than they were doing it. They were using one base and it was hundreds of miles away. And he says, we have all these portable bases all over the Middle East. And they didn't want to use them because they didn't want to offend the country where the portable, they wouldn't have even known what the hell the planes were going up, right? They wouldn't have known, but he said, no, they didn't want to defend anybody, offend anybody, and but we can do it in 4 weeks. I said, you sure about that? I'm going to call you back. I'll call you back on Monday. I'm going back to Washington. But you think 4 weeks? Yes, sir, I think we can do it in 4 weeks. We'll have time left over. So I call him on Monday. I said, you think you can do it? 4 weeks. I said, go ahead and do it. He did it. I'll tell you, he did it in 4 weeks, less than 4 weeks. So, General, stand up, please. Again, this is a real general. This is not a television general. He doesn't want to go on television. He doesn't want to go on television. I said the other guys love being on television. So we dropped 14 bombs on Iran's key nuclear facilities, totally, as I said originally, obliterating them. And that's been confirmed, and everybody understands it. Together we stopped the #1 state sponsor of terror from obtaining the world's most dangerous weapons. And if you think about it, if we didn't do that, and assuming we made the same deal that we have today, there'd be a dark cloud over this deal. And #1, it wouldn't happen because the other Arab and Muslim nations really wouldn't feel comfortable making the deal that we have now, right? If Iran had that nuclear weapon that they were about 2 months away from having. They would have had it in 2 months or maybe less than that. They were right at, this was our last shot. They looked at it for 22 years. This was our last shot. The pilots told me that. They said, 22 years, sir. They looked at it. Our predecessors looked, they studied it. 3 times a year would do drills on that exact attack. And boy, did they get it right. But let's assume they didn't, and let's assume there was large-scale nuclear weapons in the hands of Iran. We couldn't be here today. Even if we signed the deal, which we couldn't do because a lot of people would not want to have anything to do with it, we took a big cloud off of the Middle East and off of Israel. And it was my honor to help. But it isn't it true, though, that can you imagine the same, let's assume, Bibi, the same documents, we had everything the same, but you had somebody out there that was, in the opinion of everybody, all-powerful in the Middle East. They took a big hit, didn't they? Didn't they take a big hit? Boy, oh boy. They got it from one side, from the other. And you know it would be great if we could make a peace deal with them. And I think that's big. Would you be happy with that? Wouldn't it be nice, I think? Because I think they want to. I think they're tired. Somebody said, sir, they're starting their nuclear program again. I said, let me tell you something. They're not starting anything. They want to survive. The last thing they want to do is start digging holes again in mountains that just got blown up and start... They're not doing this. They want to survive, okay? But I think we have a chance. Steve, you, and I think Jared, come on, I'll call you back for another one. We always bring Jared when we want to get that deal closed. We bring Jared, but Steve, you and Jared and the General and Pete and Marco, you'll get that deal done easy. I think that'll be easy. But first we have to get Russia done. We got to get that one done. If you don't mind, Steve, let's focus on Russia first, all right? We'll get it done. In Lebanon, the dagger of Hezbollah, long aimed at Israel's throat, has been totally shattered. My administration is actively supporting the new president of Lebanon in his mission to permanently disarm Hezbollah's terror brigades. He's doing very well. And build a thriving state at peace with its neighbors. And you're very much in favor of that, I know. And it's good things are happening there, really good things. And with this week's ceasefire, we've achieved the most challenging breakthrough of them all. The most challenging breakthrough maybe ever. I mean, I've never seen anything like it. I've been involved in a lot of success. I have never seen anything like what's going on today all over the world. People are dancing in the streets, not just in Israel. They're dancing in the streets of countries that would have never danced in the street about what's happening today. They're dancing in those streets. So this long and difficult war has now ended. You know, some people say 3,000 years, some people say 500 years, whatever it is. It's the granddaddy of them all. And in an unprecedented achievement, virtually the entire region has endorsed the plan that Gaza will be immediately demilitarized, that Hamas will be disarmed, and Israel's security will no longer be threatened in any way, shape, or form. So Israel, with our help, has won all that they can by force of arms. You've won. I mean, you've won. Now it's time to translate these victories against terrorists on the battlefield into the ultimate prize of peace and prosperity for the entire Middle East. It's about time you were able to enjoy the fruits of your labor. Mr. Opposition Leader. I said he's a very nice opposition leader. I think no, he's a nice man. Bibi, he's a nice man. Good. He knows what he's doing, right? No, a very nice guy. Well, see, now you can be a little bit nicer, Bibi, because you're not at war anymore, Bibi. But only by embracing the opportunities of this moment can we achieve our goal of ensuring that the horrors of recent years will never happen again. You don't want to have to go through this again. 8 years ago, I came to this region on a very special first trip abroad as the President of the United States. I came here very early at your request. I addressed the leaders of the Arab and Muslim world gathered in Saudi Arabia and said that it was time to build a future free of the grip of extremism and terror. And interestingly, right now, as soon as I'm finished, I'm quite late. You've kept me quite late between opposition leaders and Bibi's brilliant but very long speech. I thought I was going to run up here, make a speech, and then head to Egypt. It didn't work out, though. And you made a pretty long one, too, sir. But I liked what you all said. It could be worse. Supposing on top of it, I didn't like what you said. That would be no good, Ron, would it? Ron, you did a great job, by the way, Ron. Yeah. So I'm going to be meeting, actually, in a little while, I'm going to be meeting with the most powerful, the richest nations, really, in the world. Although now, with the tariffs, the United States is by far the richest nation in the world, as you probably have been reading. But the richest nations, most powerful nations, tremendous, headed by some tremendous people in many cases. Some cases I wouldn't say necessarily I would endorse. But I will tell you, some incredible people that really helped us make this all possible. So I'll be going there. I'll be quite late. They might not be there by the time I get there. But we're going to give it a shot. But the journey we started back then led to the crushing defeat of the ISIS caliphate, to the monumental Abraham Accords, and ultimately to the historic ceasefire this week, in which many of those same nations really played a very pivotal role, I have to tell you. Steve will tell you that. Jared will tell you that. Together, we've shown that peace is not just a hope that we can dream about. It's a reality we can build upon day by day, person by person, and nation by nation. And because of that, the Middle East is finally ready to embrace its extraordinary potential. You have extraordinary potential in this region. It should now be clear to everyone throughout the region that decades of fomenting terrorism and extremism, jihadism and anti-Semitism have not worked. They haven't worked. They've been a disaster. They've just killed. They've killed. They've backfired completely and totally. They've just totally backfired. Everything that you thought, take it worst case, it's turned out to be worse than that. They have not worked. From Gaza to Iran, those bitter hatreds have delivered nothing but misery, suffering, failure, and death. They've served not to weaken Israel, but to annihilate the very forces that did the most to foment this hatred. And it's really, I mean, everybody that's tried it has become irrelevant. Meanwhile, we've seen those nations that set aside their differences, reached across ancient divides, and pursued engagement are now among the most successful in the region. They're getting along with Israel, and they're doing great. And I can tell you the 4 nations that joined the Abraham Accords early on, and you'd all be doing me a favor, and I'm going to be saying this in a little while to some other friends, would love you all to, is this right, Jared? Join up in the Abraham Accords. We have to join up and get together. You can have that whole thing filled out. We had a very weak administration, worst president in the history of our country by far. And Barack Obama was not far behind, by the way. And they did nothing with this incredible document, the Abraham Accords, but now you can fill them up. Now you have peace, you have people that really like Israel. I'll tell you what, and they like Israel a lot more today than they did even 5 weeks ago. You've made a lot of, you've come back. You've come back strong, because it was getting to be a little nasty out there in the world, and ultimately the world wins. You can't beat the world. Or I would say to Bibi, it's now time. And he understood it better than anybody, because ultimately, you know, the world's a very big place. And I've said a lot. I said, this piece of land is very small. It's unbelievable what you've done with that tiny, you look at a map even of just, not the world, the Middle East, and you have this little dot. And think of what you've done. It's incredible. It's incredible. But the world is loving Israel again. And I said to people, you know, the world is big and it's strong. And Ron, ultimately, the world wins. And we don't have to worry about that now. But there was getting to be a period of time over the last few months, you know, the world wanted peace and Israel wanted peace. Everybody did. Everybody did. And what a victory it's been, right? What a victory it's been. If you would have gone on for 3-4 more years, keep fighting, it was getting bad. It was getting heated. The timing of this is brilliant. And I said, Bibi, you're going to be remembered for this far more than if you kept this thing going, kill. It would be it would not be the same. And I just want to congratulate you for having the courage to say, that's it, we've won. And now let's enjoy our lives and let's rebuild Israel and make it stronger and bigger and better than it's ever been before. We're going to do that. Took a lot of guts. And the choice for Palestinians could not be more clear. This is their chance to turn forever from the path of terror and violence. It's been extreme, to exile the wicked forces of hate that are in their midst, and I think that's going to happen. I've met some people over the last couple of months that want to see it happen very much, and after tremendous pain and death and hardship, now is the time to concentrate on building their people up instead of trying to tear Israel down. We don't want that to happen again. And the total focus of Gazans must be on restoring the fundamentals of stability, safety, dignity, and economic development so they can finally have the better life that their children really do deserve after all these decades of horror. I intend to be a partner in this effort in the sense that we're going to help and we're going to do something that became unbelievably popular. Everybody wants to be on it. It's called the Board of Peace, okay? How about that? Is that a beautiful name? Like a board of peace. The only bad thing from my standpoint, every single nation involved has asked me to be the chair, and I'll tell you, I'm very busy. I didn't count on that, but you know what? If we do it, we'll do it right, and we have unbelievable power and wealth. Because you're going to need wealth. You're going to need wealth to rebuild things. And they have wealth like few people have wealth. I want to thank the Arab and Muslim nations for their commitment that they've made to support a safe rebuilding of Gaza and beyond. I have many Arab countries, very wealthy countries, that came up and said, we'll put up tremendous amounts of money to get rebuild Gaza, and I think that's going to happen. The power, they want dignity, they want to come forward, and they want to say, and I want to say who they are, because what they're doing is going to be, I think, something that you're going to be very impressed with, Bibi, and you need that. You need the kind of economic power that they have, and they want to see it work, and they want to see it be safe, and they want to see it be good for Israel, too. And as much money as it will be, and it's a lot, as you can see, it's a lot. For these countries, it's relatively little relative to their worth. It's really a lot of money like most people could never even conceive, but for these countries, it's not that much, especially because it ensures success and stability in the Middle East, which is what they want to see. So many of them will be with us in Egypt in a little while, I think. I'm not sure. They may be gone. They may have taken their Boeing 747s and left. I said, what kind of a plane do you fly? 747. I said, that's a large plane. No, they may have. Steve, do you think they've left on their their brand new Boeing 747s? Or I don't know. We're going to find out soon. It's going to be a big story. There'll be 2 people left. And they'll be the 2 poorest ones. But it will be the wealthiest and most powerful group of nations. So the group that we have assembled, that's waiting for us, is the wealthiest and most powerful group ever assembled at one time. There has never been a group like this. And they're only looking for good. They want good. They're going to do good. And as those commitments are made, I'm going to let the world know who's doing it, because they really deserve to get the credit. And some of them probably won't want the credit, but they deserve it. It's more obvious than ever that the productive and responsible nations of this region should not be enemies or adversaries. You should be partners and eventually even friends. And that's what's going to happen. I know it. Together you can stand against the forces of chaos. Yeah, you go ahead. That's an important point. Because you can stand against the forces of chaos that threaten all of your interests, and it's always a big threat, and unleash incredible prosperity and opportunity for all the people of these lands, and that's what's going to happen. You're going to unleash numbers and success, the likes of which Israel has never been able to think of, because you're so firm, and you should be, and you've done the right thing in defending yourself. You're not going to have to worry so much about it. You've won, and now you can build, and you can do things that you never even thought possible. When you put that genius into doing something else, it's going to be something it's going to be a miracle. The miracle in the desert, it's going to be amazing. And it already is in a true sense. But it'll be wonderful when you can spend time thinking about other than war and defense and offense also. To that end, it's my firm hope and dream, frankly, that together the Abraham Accords will turn out to be everything that we thought they would. Those 4 countries were very, very brave in doing it. They did it at a very early point, and every single one of them benefits unbelievably financially. And if you noticed, even in this bad period that we just went through, they all remained a member of the Abraham Accords. They've done unbelievably well. And you know who you are, and I want to thank you. And they've stayed because of loyalty, but they've also stayed because it was really good business. They've made a lot of money being members, and you're going to all, I hope that every one of the countries that we're seeking, Jared, I hope they join quickly. No games, no nothing. Just join, get it. It's going to be a great peacemaker. It's really going to bring it together beyond anybody's wildest dream. So instead of building fortresses to keep enemies at bay, the nations of this region should be building infrastructure to weave your commerce closer together, because you've got to compete with the big world out there in commerce now. It's a different kind of competition. Instead of making weapons and missiles, the wealth of this region should flow to schools and medicine, industry, and frankly, the new hot thing, artificial intelligence. It's a lot of intelligence you're going to have to be thrown off to pay back these sums of money that they're doing. But that's really the hot one. And I might say that the United States, a year ago, was a dead country. I say it to people. I heard it first from the King of Saudi Arabia. I then heard it from UAE. I heard it from Qatar. I heard it from many other countries. A year ago, the United States of America was a dead country. Now it's the hottest country anywhere in the world. It is the hottest. There's no question about it. In fact, if you go back a year ago, before the election, although once we had November 5th, we became hot because people got it. I would say November 5th was a time that we became really hot. But once you go back a couple of years, if I were in charge and the country was doing what they would, nobody was going to ask me to speak. Nobody asked Joe Biden to come up and speak, I guarantee you that. And if they did, he would have turned them down, I promise you. He didn't speak. He didn't speak, and he didn't speak well. But all of the countries in the Middle East, it could have, what we're doing now, it could have happened a long time ago, but it was strangled and set back almost irretrievably by the administrations of Barack Obama and then Joe Biden. There was a hatred toward Israel. There was an absolute hatred. The setbacks really started when President Obama signed the Iran nuclear deal. This was a disaster for Israel, and it was a disaster for everyone. And I remember that Bibi Netanyahu came to the United States and worked so hard to try and get Obama not to do that deal. He worked so hard. But it was like talking to a wall. I remember him telling me it was like talking to a wall. They wanted to go with Iran. They chose Iran, frankly, over a lot of other good nations, but specifically Israel. And that was the beginning of a very bad period of time. You had Obama go out, and the Iran nuclear deal turned out to be a disaster. And by the way, I terminated the Iran nuclear deal, and I was very proud to do it. Yet even to Iran, whose regime has inflicted so much death on the Middle East, the hand of friendship and cooperation is open. I'm telling you, they want to make a deal. That's all I do in my life. I make deals. I'm good at it. I've always been good at it. And I know when they want. Even if they said, we don't want to make a deal, I can tell you they want to make a deal. All right, they do. They want to make a deal, and we're going to see if we can do something, because this is crazy what's happening, and we're not going to have this anymore. Neither the United States nor Israel bear the people of Iran any hostility. We merely want to live in peace. We don't want any looming threats over our heads, and we don't want to even think in terms of nuclear destruction. It's not going to happen, never will happen. There's nothing that would do more good for this part of the world than for Iran's leaders to renounce terror, stop threatening their neighbors, quit funding their militant proxies, and finally recognize Israel's right to existence. They have to do that. They have to do that. And to Iran,
what could be a crowning moment for the president's foreign policy, the president of the United States addressing the parliament in Jerusalem, Israel, before travelling to Egypt for a signing ceremony following a US-led deal reached in the last week, which led to an amazing moment in this region earlier this morning. Hamas freeing 20 remaining living Israeli hostages and Israel releasing 2,000 Palestinian prisoners in response. Some standout headlines from this address in the last 60 minutes or so. The president saying, for Israelis, Palestinians, the nightmare is over. This will be a golden age for Israel and for the Middle East as a region.
He really emphasized the rejection of certain extremist policies and started talking about the need for coalescing as he heads over to Egypt. A real question of how much he and some of the other members, heads of state that are going to be meeting, are going to lean into the Abraham Accords and continue a closer alliance with Israel. It really solidifies, though, how important this region is as a geopolitical node for President Trump and, frankly, increasingly for the entire world.
The president of the United States, the difference maker here. This didn't look like it was going anywhere for a long, long time. Moments ago, the president saying this is the start of an era of harmony for Israel and for the Middle East.
It's really a foreign policy achievement thus far for this administration. The remaining question is what comes next when it comes to this peace agreement. The hostages are released. You have Palestinian prisoners leaving the West Bank. But how do they redevelop Gaza? Who is going to run this transitional authority? So the president right now is speaking in Jerusalem, but how many times has he said, I'm going to Egypt next and Sharm el-Sheikh, and it's going to be an unprecedented peace summit? That is where his mind is right now, because that could be a continuation of what started under Trump 1, which is an expansion of the Abraham Accords.
If you are just joining us, welcome to the programme as we count you down to the open about 90 minutes away. Equity futures have bounced back following remarks from the president over the weekend, just dialing back the temperature between the US and China. We'll bring you market coverage in just a moment. I want to cross over to Bloomberg's Ollie Crook, who's on the ground in Jerusalem. Ollie, welcome back. As Annmarie said, just to build on her words, a crowning moment potentially for the president's foreign policy. But what's next, and how durable will this peace be?
Yeah, Jonathan, I think that is sort of the main question here before us, is the durability of the sort of experimental foreign policy that has gotten us to an outcome that would be really very impossible to imagine coming together in this way under really any other kind of president. And the question, I think, today, I mean, we should just mark the moment, this moment of Trump speaking, still speaking before the Knesset, really going, thanking his entire team and making some nods to kind of what his ultimate goal is for the region, talking about the Abraham Accords, talking about bringing peace to Gaza and to trying to redevelop it into a prosperous economic zone. But as you say, Jonathan, we are in the foothills of what is going to be a very complex and very long discussion about how to get there exactly. And I think that the joy today from the Israeli side, the joy today from the Palestinian side as they take their prisoners back, it masks the bitter complexity of the issues that are still to come and need to be discussed and that will begin to be brokered in this meeting in Egypt a little bit later. The question is going to be, who will the stakeholders be and what will their commitment be to try to bring security into the region of Gaza? Remember, this has always been the sort of main sticking point. You need a security arrangement within Gaza that the Israelis can live with, that theoretically the Israelis are not sort of running, but at the same time that the Palestinians find to be legitimate. You need that in place in order to have a governing structure on top of that, this sort of technocratic board that is going to be overseen by this sort of board of peace by Donald Trump. And he says a great many leaders who want to be involved. But before any of that happens, Jonathan, there needs to be a conversation about Hamas. What happens next with Hamas? Are they willing to lay down their arms? To what degree? There are provisions within Trump's 20-point plan to say that basically anyone who's willing to lay down their arms will be granted amnesty, will be granted safe passage. But even in the last few days, Jonathan, we've had reports of Hamas reasserting itself within Gaza, also punishing Palestinians that have been sort of seen as cooperating with the IDF. So these are the sort of prerequisites to make any sort of the great gestures that Trump is talking about here, talking about a historic dawn for the new Middle East and, God willing, an eternity of peace. That eternity of peace is still many, many steps away, and that is the very difficult and grueling process that will begin a little bit later in Egypt today.
The hard work continues. Ollie, thank you. Great work this morning tracking this story. Bloomberg's Ollie Crook in Jerusalem. As we count you down to that opening bow, just to reflect on the price action this morning, equity futures a whole lot firmer on the S&P 500. Coming up this hour, we'll catch up with Seema, Shah of Principal Asset Management as stocks bounce back, Saul Martinez of HSBC as we look ahead to key bank earnings later this week, and Abigail Watt of UBS as the government shutdown enters its third week. We begin this hour with stocks bouncing back as President Donald Trump tempers his trade stance on China. Seema, Shah of Principal Asset Management writing the following: even after the strong performance of the past 6 months, with the S&P 500 up 35% from its Liberation Day trough, equity markets have further room to run. Seema joins us now for more. Seema, welcome to the programme. Will you get a helping hand from earnings season and from bank earnings this week?
Hey, John. Yeah, I think that is definitely on the cards. You know, when we're looking across at the macro outlook, we're still feeling pretty positive. Of course, there are some signs of slowdown within the labour market, but we're not talking about recessionary area. And typically in this kind of environment, we can see continued performance from financials. So along with those tech stocks, which continue to drive the market, we would think that financials can join in with that rally and help push the equity market a little bit further.
Seema, it's not just bank earnings on the calendar, also a meeting potentially between the two leaders from China, from the US, President Trump and Leader Xi. Seema, how big a factor will that be in your outlook? The trade negotiations, the friction, the tension between China and the United States?
Yeah, it's a great question because, you know, in the last couple of weeks, it's completely fallen out of the headlines. You know, nobody really talking about the risk associated with it. So the news on Friday, I think, did come as clearly did jolt the market. It has the potential to have very, very serious impact on the economy, both from a growth side and from an inflation side. So we obviously have to keep a close eye on that. At the moment, from our perspective, we're going to go along the assumption that things eventually kind of work themselves out. Simply because the risk is so big, but it does clearly have the potential, and so investors. And I think the key thing is that there has been so much complacency within the market about what could happen to how much further the equity market could run, that this has been a good reminder that there are still risks on the horizon.
Risks of re-escalation between the U.S. and China, how much does it also reiterate the risk that this is not just a one-time price shock, but it's an ongoing process of tariffs that come on in different waves and price effects that happen over time, kind of like what we saw from Levi's last week?
Yeah, and, you know, Elisa, I mean, I think this is one of the things that we've been considering is that from the tariff perspective, this is an ongoing story. We know that tariffs are going to be used continuously as a geopolitical tool and for any other kind of negotiations that the US is looking to do. We're also expecting, even before Friday, that tariffs would continue to move a little bit higher. They'd change in focus sectors, more company focus. So I think this is still inbuilt. But we have seen time and time again that from a market perspective, these kind of headlines, they do start to move back and back and back in people's mindsets, especially as companies do start to kind of navigate their way through. So it's not to say that there won't be any impact. There will be. It is contributing to an economic slowdown, but we're not looking at something which is recession-like, provided the US-China negotiations do move in the right direction over the coming weeks.
So if there isn't really that great of a chance of recession, which is what I'm hearing from you, do you buy any dip? Was what we saw on Friday something that you want to welcome, usher in, and dive into?
I do think, I think any kind of noise, either with regards to the shutdown or even with the trade tensions, these are opportunities because we're trying to look beyond the noise. And, you know, this has been a really good learning for this year, is that back in April, when everyone was really worried about recession, they were worried about how there was going to be a very significant market correction. We are up very, very significantly from those moments, and the market has managed to look through. So we would assume that this is going to be a continuation. Valuations are that much higher. The economic backdrop is a little bit slower. So, you know, we're not going to be expecting to see gains as significant as we've had in the last couple of months. But to our minds, this is still a positive setup for equities.
The issue, though, with what's going on with trade is that J.D. Vance is talking about the fact that it's up to Beijing to choose the path of reason. Does it not feel different this time than it did in the spring?
There are definitely differences. And I think the key thing is that, you know, China is showing that it has a lot of power in this. You know, it's got a very, very strong negotiating tool. So it's very much sitting in, I guess, in their area. And, you know, what is the US going to do to kind of bring down the tensions? So there is a difference. But I think at the end of the day, because the impact could be so serious, it's almost that too big to fail situation, which we would assume is going to push both sides to some kind of negotiation point. It doesn't necessarily mean that we're going to be looking at lower tariffs. We could be even looking at slightly higher tariffs than where they are today, but we wouldn't expect there to be a move back to the 135% tariffs that we did see earlier this year.
Do you think this just gets done by November 1st, where the president said that seems like an eternity for him, or is this a 2026 story for the market?
I think we can get somewhere by November the 1st. And I have to say, I think it's going to be a very, very rocky road with a lot of noise, a lot of back and forth. But certainly, I think that the issues with China is not something which can be put to bed very quickly. I would assume that this is going to be a situation that we're going to be talking about through 2026, through 2027. And that rivalry between the two countries is going to be something which is a continued pain point, which comes back to rock the market every now and then over the foreseeable future.
What was interesting, and John pointed this out earlier, is that on Friday we saw a rally into U.S. Treasuries. And this was different than what we saw after the April 2nd Liberation Day. And it raises the question about whether the market is looking through any kind of price shocks as one-time, transitory, or whether it's complacent about the inflationary ramifications of this decoupling between the U.S. and China over a longer period of time. How do you see that?
Yeah, it's an interesting one because, in the last couple of months, you haven't really seen the inflation impact that people were anticipating in April. And so I think that what we saw on Friday was just this assumption that, this is a continuation. There will only be a one-time shock. It'll be very modest. This is really, really early days. So to our minds, one of the key risks that we do need to look out for in 2026 is, the inflation numbers moving a little bit higher than anticipated. At the moment, we're expecting CPI to be hovering around the mid, I should say the 3.2 to 3.3% level. If we were to see it move above the 3.5% towards a 4% number, well, then I think the equations kind of change. And I think that would be a real sticking point for the market. But it is really early days. And I think as we go into earnings season, that to us is going to be the key thing that we're listening out for. What are CEOs telling us about the price impact, how much they're planning to be passing on? And I think that picture won't be very clear until we're looking into Q1 or Q2 of next year.
Seema Shah of Principal Asset Management. Seema, thanks for jumping on. Appreciate it. Appreciate your time. Thank you. I'm pleased you went there. I think it's just so important. I'm sitting here again after about 2 hours of this programme, reflecting on the fact that I think we've barely spoken about the Federal Reserve for more than 2 minutes. And I'm always thinking about what are we missing? What's the market missing? What are people not talking about? What do they need to consider more? The prospect of the Federal Reserve not cutting interest rates beyond the next meeting. Say, a Federal Reserve that until May, when you get the leadership change, is trapped in disagreement about what's happening in the labour market and ultimately what's about to happen to inflation too. Now, we won't get CPI this week because of the government shutdown, but if you look at the estimates for when we will get the CPI release, which is going to be October 24th, I believe, we're looking at a 3-handle. You've got a 3-handle on inflation. I think you've got a much stronger case for the hawks on the FOMC to say, what are we doing, guys? Over at the Federal Reserve, cutting interest rates with inflation running in the 3s. And it's that sticky point between now, May, and the leadership change of the FOMC, which I think needs some more attention.
I think you're absolutely right. How much this is going to be a Fed that pushes back because of inflation, and how much is this going to be a market that pushes back? One thing people have pointed to is the long end of the yield curve has been incredibly complacent, hasn't really talked about some sort of huge spike up in inflation. You're seeing that in break-even rates as well. Does that start to shift if you don't get a change in tone from the Federal Reserve?
Stocks are doing okay this morning so far, up by 1% on the S&P 500, taking a bite out of the losses from Friday. Let's give you an update on stories worldwide with your Bloomberg Brief. Let's cross over to Lizzie Burden. Hey, Lizzie.
Hey, John. President Donald Trump heading to Egypt now for a Middle East peace ceremony after speaking at the Israeli Knesset. He spoke following the release of all 20 living hostages from Gaza. Once the hostages are freed, Israel has agreed to free almost 2,000 Palestinian prisoners and allow more aid into the Gaza Strip. The Trump administration is also signalling that it's open to doing a deal with China, days after announcing new 100% tariffs effective November 1st. The relationship between the two countries soured last week when China announced new export controls on rare earths. President Trump posted on social media, quote, "Don't worry about China, it'll all be fine." And First Brands named Charles Moore as its interim CEO after CEO Patrick James stepped down effective immediately. The auto parts company is facing increased scrutiny over its sudden collapse. The Justice Department is examining how Wall Street lenders missed red flags before First Brands filed for bankruptcy, owing more than $10 billion. And that's Bloomberg Brief. John.
Lizzie, thank you. Appreciate it. More from Lizzie in about 30 minutes' time. Up next, the morning calls, plus Saul Martinez of HSBC as we preview key bank earnings on deck through this week, Tuesday and Wednesday. From New York City this morning, good morning.
I think the world is at the early stages of almost an ESG type moment. This is just going to expand and expand. I do think we're going to have economic friction, tariffs with China, so that's going to be a bit of a way on some parts of the market. And the other part, anything that's production for security, pharma, tech, chips, rare earths, critical minerals, natural gas, all those things should do very, very well.
There is going to be some serious investment on that front. That was Tchir of Academy Securities. If you're just joining us, welcome as we count you down to the opening bell. 1 hour, 13 minutes away. Equities bouncing back. Futures up by more than 1% on the S&P. On the Nasdaq 100, higher by 1.8%. That's the price action. Here are your morning calls. First up, Bank of America downgrading Intel to underperform, saying the stock has gone, quote, too far, too fast. Next up, Mizuho raising its price target on Nvidia to 225, expecting China headwinds to be muted. That stock is up by 3% this morning. And finally, Citi cutting its price target on Blackstone to 170, saying to wait for a better entry point. If this ain't it, I don't know what that entry point looks like. We're up by 1.6% this morning. Those stocks have been hammered over the past month or so. We'll get to them in just a moment. Let's stick to the financials with a slew of earnings out this week. Saul Martinez of HSBC writing, we expect third quarter 25 results to reinforce the positive narrative driving the outperformance of large cap US banks and brokers. Saul joins us now for more. Saul, good morning.
Good morning.
Hey, it's good to see you. I touched on it there. Blackstone, KKR, Apollo. They've been hammered over the past few weeks. It feels like the market's treating them as a proxy for some of the developments we've seen in private markets, First Brands, Tricolor, all that stuff. How are the banks exploring those stories at the moment?
Yeah, I think right now, and it actually has impacted the bank stocks some. You have seen, since we put out our preview a few weeks ago, the banks that I covered down 5 to 10%. And part of it is the realization that the macro dynamics are still a little bit unclear, and credit is something to focus on. I think at this point, though, credit should be fine for the banks. Just remember, the banks, the big banks, especially those that are systemically important, have been very conservative really since the GFC in terms of their lending portfolio, and that's really been what's allowed private credit and non-bank lenders to take share. So there has been that conservatism. And I think if you look at some of the data thus far, the credit card issuer data through August, you're actually seeing better performance on credit cards, better delinquency rates, better NCOs year on year. The most recent updates that the banks have given as of early to mid-September suggest that the commercial loan portfolios are performing well. Commercial real estate's doing well. That said, look, you're right. You have had some credit situations like Tricolor, like First Brands. You had CarMax having bad results. So it is something, I think, that will be monitored. I don't think it's something that will show up in results. I don't see this quarter being one where you start to see credit worsening. But I think you have to look for things like, are delinquency rates moving higher? Are banks reserving more, because that gives you a proxy for their what their estimated losses are? Are they classifying more commercial loans into criticized asset buckets? So those are things that we'll be monitoring. I think the banks are fine for now, but that said, I do think it pays to pay attention and to look at banks who are good underwriters but are also well reserved for potential losses.
You make a lot of great points, and I think one point of the past cycle has been that private credit is pulled up in business that banks might have taken on earlier, but they now have. I just wonder if there's another message here. Can you really have a reacceleration in the U.S. economy if you have these potholes in consumer credit, in auto lending, in other areas that raise red flags about just how quickly this economy actually is reaccelerating?
Yeah, I mean, look, that is a fair point. I think the bull case for banks right now is that you have a good economic backdrop, moderate growth, interest rates across the curve are at we have positive real rates across the curve, so that is allowing for net interest income to grow. And more recently, you've actually had some optimism about loan growth. Loan growth has actually picked up for the banks. The quality of that loan growth we can talk about, but there has been some improvement. So the positive view for banks is that revenue picks up, But that really depends on rates staying where they're at. It really depends on the economy continuing to grow. If you were to see a soft patch in the economy and the Fed cuts more than what's priced in, which is I think about 5 times this morning when I checked, and the 2- and 5-year part of the curve is also important, and that has come in. You're still at levels that are well anchored in that support asset yield expansion. In other words, fixed rate assets and loans are repricing to higher rates, and there's a benefit there. There's a little bit less of a benefit than there was 6 months ago. That said, if the situation you described, where the economy really hits a soft patch and it happens, rates will come down across the curve. That's actually what happened in 2018. Remember, in the first Trump administration, banks did very well in 2016 and 2017 for very similar reasons. And we had tax reform, fiscal policy, expansionary fiscal policy. And then 2018, 2019 came, and rates collapsed across the curve, and bank stocks really underperformed during most of Trump's first presidency. So that is a risk. I don't think we'll get there for a lot of reasons, but certainly a weak economy is one that is not consistent with a bull case for banks.
Up until now, there's been this competition between private asset managers and the banks, and it's been the sense has been that private asset managers have had the upper hand. Can you put into context the J.P. Morgan announcement this morning about the $1.5 trillion of financing for specific strategic areas in the United States and pair it with this sort of race, or do you think it's a completely separate story?
I don't know if it's I don't know if it's completely related. I think for the banks, what the banks are trying to do, the banks are trying to service their clients effectively, right? And they're entering into relationships with private credit firms. But for a bank, a lending relationship often is sort of an anchor, right? They're not making high profitability in the lending relationship. But it's the other business that is associated with it. You provide credit, but you also get the investment banking, the treasury services, the core deposits. And it often probably makes sense more economically for banks to provide a full service for their corporate clients, but not necessarily to keep the risk on their balance sheet and partner with private credit firms. So I think with J.P. Morgan and a lot of the banks, and they're doing it somewhat differently, J.P. Morgan is keeping some of it on their balance sheet. They're trying to provide their corporate clients with all the financing and all the potential products that lending products that are out there and that they need. While still partnering with private credit, so it is a sort of a frenemies type of relationship, right? The private credit has taken share in terms of lending, but it's also a vehicle for banks to sort of partner with private credit, offload some of that risk, but maintain that relationship with the corporate.
Lisa brought up J.P. Morgan. Got about 60 seconds left. They report tomorrow. Goldman Sachs as well. It's fair to say you're less constructive on those two names.
We are.
Why?
It's valuation, really. I mean, I came here last time 3 months ago, and I just downgraded them, and feel the same way. I think for J.P. Morgan, I think for both the quarter should be fine. I think it should be reasonably good. But J.P. Morgan is trading at 2.9 times tangible book value. You're pricing in a heck of a lot there, and they have a lot of excess capital. But buying back stock at 2.9 times tangible book value is not necessarily the best. May not be the best use of capital. I think Jamie Dimon would agree with that, right? So that the fact that they're not buying back their own stock does tell you something. I think Goldman has some tailwinds there. You feel like I'm swimming against the tide sometimes with being cautious on Goldman. But look, if the market does take a breather, you're at 15 times earnings. Over half of the revenue of Goldman is sales and trading. That's not a high multiple revenue stream. So we just think the risk reward here is over time, much more skewed to the downside with both of those stocks.
It's good to see you. Likewise. Thanks for dropping by. Thank you, sir. Saul Martinez there of HSBC. Looking ahead to earnings from JP Morgan, Goldman, Citi, Wells Fargo tomorrow on to Wednesday when we hear from Bank of America and Morgan Stanley.
And expect to hear a lot about investment banking, the mergers and acquisitions that we've been hearing about and that Jeffrey said that they had a record revenue from. Let's hear what JP Morgan and Goldman Sachs has to say tomorrow.
Looking ahead to earnings season for the big banks. Coming up next on the programme, Abigail Watt of UBS as the government shutdown enters week 3. Plus, Shah has your morning movers. Warner Brothers Discovery higher. On reports, the company has rebuffed Paramount Skydance's initial takeover approach. Snapping a 2-day losing streak on the S&P 500, bouncing back from the biggest one-day loss since April 10th. Equity futures up by more than 1% this morning on the S&P 500, on the Nasdaq 100 up by 1.7. As we count you down to the opening bell, about 60 minutes away with your morning movers with more. Here's Yahara. Hey, Yahara.
Hi, John. You said it. We are bouncing back. Nvidia and AMD shares both rising in the pre-market, up more than 3%, along with the rest of the Mag 7. And that is because President Trump struck a softer tone on China over the weekend, saying that he wants to help China, not hurt it, despite him threatening 100% tariffs on the country. But these chips are, of course, central to the trade negotiations because they are core to the U.S.-China tech rivalry. Meanwhile, moving on to shares of Warner Brothers Discovery, they're up 4.6% on our reporting that it rejected Paramount Skydance's offer as being too low. We're reporting the offer was around $20 per share, just above where we're trading now, but that Warner Brothers Discovery was looking for something closer to $40 a share. And we end on StubHub, another rally here, up more than 5% in the pre-market after it received a wave of bullish ratings by analysts on Wall Street after its September IPO. The company is already a major player in the secondary ticketing market, but they say that it is well positioned to be a big player in the primary ticketing market and that it will likely get a big boost from big events like the 2026 World Cup because you know those tickets are going to be off the charts. John?
Offensively off the charts. Yahara, thank you. Ridiculous. Have you seen some of the prices?
I knew you were going to go here.
Of course.
Of course. It's sort of like, well, let's talk about ticket prices.
It's basically like, don't buy anything for the entire year.
I'm going to host viewing parties at mine instead.
Oh, yeah?
Okay, yeah.
Everyone's invited.
Select few invited. Everyone is.
You're a fan of Jonathan Ferro.
Rather
go
loose.
to his house.
Don't do that. Okay. One more stock for you. The Walt Disney Company in the pre-market up by 2.5%. The power of Taylor Swift. Taylor Swift announcing new programming for Disney Plus for the month of December, and the stock straight away, just like that.
Yeah.
Higher.
Content's still king. And I think that was what we've been hearing, that honestly, a Netflix CEO talking about the importance of getting more content. Even though we had been over-contentinized, that's not a word, I think people are leading back into the idea of getting the key names.
Saturated.
Thank you.
But I liked your phrase better anyway.
Yeah, it's very hard to say.
It's like media speak. They just make things up, you know?
Contentiousized.
Yeah, as always.
I'm looking at these tickets. They're unbelievable. For the World Cup.
Give me a price. You want to go back to that?
Okay, so if you want to sit close, you're looking at $20,000 to $30,000.
That's for the final.
You are looking at one ticket. I have 4 left. $101,000 could be yours. This is insanity.
Not mine.
228,000, 65,000, 17,000 per ticket. I guess we're not going to the World Cup.
Viewing parties at Abramowicz too, all right? And that really is for everyone. Okay.
Oh, is that your comeback?
Don't do that either. Okay. Turning to the economy, another week of data that may well be delayed, but we will get some Fed speak over the next few days. Tracking that is Bloomberg's Mike McKee. Mike's holding parties too. Viewing parties for economic data, Mike, October 24th. I heard we're all coming round. We're skipping the show and we're waiting for CPI. Mike, is that the date we now get the inflation report?
That's the date we now get the inflation report. We won't get it this week. I was just thinking what you were talking about. The price of the athletic event admissions is going to really feed into CPI next year. So let's hope we get back to the CPI releases so we can find out what it does to the economy overall. I'm in Philadelphia, where the National Association for Business Economics is holding its annual meeting, and it is about the Fed here. 72% of the economists here surveyed by the group say that the Fed is about where it should be right now, and they only expect one more rate cut this year. We'll get some hints as to whether they're on the right mark with a lot of Fed speak. I put Anna Paulson's full name up there. She is the new Philadelphia Fed president. This is her maiden speech that she is making at noon today, so everybody will want to pay attention to that. The highlight of the week is Jay Powell, the Fed chair, speaking here at the NABE meeting tomorrow on the economy. Everybody's going to want to know what he says about what they do next. You can see a couple of these people are speaking several times. Mickey Bowman speaking twice, Chris Waller speaking twice. And how many Myrons are you going to find this week? He was put on the Fed to make the president's case for lower rates, and he's going to make it. over and over and over again. Now, we aren't going to get CPI, as you mentioned, that's October 24th, but there are some other key numbers we're not going to get this week. We're not going to get jobless claims, we're not going to get retail sales, and we're not going to get the PPI. And of course, Friday, housing starts and import prices, along with industrial production, which is put out by the Fed, but they use numbers from the other reports, so they can't do it either. So it's going to be very interesting to see what the Fed has to say this week, what Jay Powell tells the economists here, and how they're going to translate that into what they think is going to happen to the economy. And I got to tell you, there was a lot of talk last night about the president and China and whether or not we're going to get those additional tariffs. And there's real concern that if they do go through, that's going to be a big negative.
Interesting. Mike, thank you. Looking forward to your coverage of the event over in Philadelphia and looking ahead to what we could hear from Chairman Powell later this week as well. Let's stick with the data still impacted by the government shutdown. Abigail Watt of UBS writing the following. If the government reopens early in the week, it's possible that we may receive the September employment situation within 2 or 3 business days. Abigail joins us now for more. Abigail, if we don't, we could have this really strange situation at the end of the month where the Federal Reserve has the CPI report but doesn't have payrolls, has CPI about 3% and still decides to cut interest rates. How uncomfortable might that moment be?
Morning. Thanks for having me join. Yeah, look, I think you're totally right to focus in on the kind of balance between the labour market and the inflation data. I think that's clearly what drove the cut in the September meeting, was this shift towards concerns over the labour market. And while we might not get the September employment report, as you say, the FOMC are expected to get the September CPI data later this month, which I think will be helpful for them in understanding kind of potentially where that balance of risks is. I would say that even though we don't have the September employment report, we do have kind of other data that we can look at to get a sense of the state of the labour market. And in particular, you know, we've been looking very closely at what we're seeing in the initial and continuing claims data. These data are not being published, you know, in the normal kind of formal report from the Department of Labour, but we are able to kind of patch together the kind of state level data, and you're continuing to see kind of elevated levels of continuing claims in those data as well versus this point last year. So I do think that kind of balance between the two, you know, the labour market data and the inflation side will keep the Fed on track to kind of cut at the meeting at the end of the month.
Abigail, what initially kicked off the sense that the Fed might be behind the curve and needed to catch up by cutting rates was the revisions to the payrolls that really came in so much more significantly than people expected. But Sonal Desai was on the show last week, and she said, actually, what it means is that the economy was doing pretty well without all of those jobs and without that job creation. Doesn't that speak to a wave of productivity, not necessarily to a real weakness? I mean, how do you sort of square these ideas that maybe we are just operating with a lower job creation base?
Yeah, look, I think obviously there's been, you know, a wealth of people kind of coming out with estimates of what the run rate of kind of payrolls or the run rate of employment growth might look like, particularly obviously given the shifts we're seeing in terms of potentially population growth, but also kind of what we're seeing in terms of changes in participation rates. I think we've seen obviously participation kind of coming off a little bit, and I think that's probably likely driven by cyclicality rather than, say, kind of demographics, which has been the kind of downdrift that we've seen there in kind of recent years. I think the question in terms of the kind of run rate and kind of the tying together of what we're seeing in terms of growth in the labour market, I think really what you've seen is a step down just in terms of demand within the labour market. I do think it's potentially more demand driven than it is supply driven at this juncture. And I think one of the things we have seen is obviously a lot of noise in terms of the growth numbers with swings from kind of noisy components, but you have seen a step down in terms of the pace of domestic demand. That underlying pace of demand in the US economy was relatively soft through the first half of this year versus where it was last year. So I do think the kind of slowdown you've seen in the labour market and the slowdown you've seen in kind of the broader economy are kind of broadly consistent with one another.
How do you square that with Delta? And I know that this is sort of not a perfect data set, but it's the data set that we have. Delta reported earnings and it was better than expected. And they said they see no reason for there to be any softness in the path ahead. They're seeing demand really pick up across the board. How do you square that with the decelerating in labor demand that you just talked about?
Yeah, look, I think there's a potential reason for that could be that we are seeing narrowing, I think, in terms of the drivers of consumption, right? So one of the things that we've been referencing for a while is that we'd expected that the lower end of the income spectrum would become under more pressure through the beginning of this year. And I do think we have seen that. I think one of the things we have seen, though, is that the upper income groups are continuing to sit on relatively healthy balance sheets. And there's a number of elements that we're seeing in terms of the income data, particularly the NIPA revisions, with a big kind of revision in terms of dividend income supporting income growth in recent years. And I think that's also unlikely to be equally distributed across the income distribution. So if you think about kind of where the kind of support for kind of recreational services is coming from, it's likely to be coming from those upper income groups disproportionately. So I think that's the reason why, you know, we have a slowing in terms of the economy. We have a slowing in terms of consumption, given the potential for kind of pass through of tariff headwinds later this year. But we don't have an outright contraction. And I do think it is because you do have that kind of stronger upper income group in particular, still kind of able to support, you know, the pace of consumption as we go forward.
Abigail, when it comes to tariffs, how are you thinking about the latest rhetoric we have when it comes to Beijing and Washington and potentially an increased tariff rate on China?
Yeah, look, I mean, China is the area where we have seen, obviously, the strongest kind of ratcheting up of tariffs. They're sitting with the highest weighted average tariff of kind of any country and trading partner that the US has. And I think, you know, the kind of resurgence of the rhetoric around potential for the 100% tariff to be added late last week. I think this is just a timely reminder that this is an area where we could continue to see tensions kind of flaring up. Obviously, we had the kind of November 10th deadline already in the calendar for the potential for the reciprocal rate on China to increase. I think, you know, the kind of deadline here for the 100% of November 1st potentially gives you a little bit more time to see kind of more progress and negotiations between the two. So I think for now, you know, we're watching to see how that progresses. I think obviously the experience of earlier this year, we saw a very strong kind of increase in terms of tariffs on China that proved relatively short-lived. So we would be watching to see kind of how that rhetoric develops in terms of before we would want to kind of think about how that might feed into kind of the economic outlook and our expectations.
Abigail, thank you. Appreciate it. Abigail Watt there of UBS with the latest on the economy, the lack of data and the Fed speak. You said it. You brought up Delta. Who needs data when you've got Delta? It is the Delta Airlines economy.
And the JP Morgan and Goldman Sachs economy tomorrow. And we already got a hint of that from Jefferies, and all systems seem to be a go. So at a certain point, if that fills the void, how do you draw the distinction between a slowdown in the labor market when engines are really firing in the retail space, in the travel space, and in the banking space?
Tricolor, tricolor, whatever it's called. I'm getting confused now. First brand, a lot of exposure to subprime. The thing is with the banks, they don't have that exposure to subprime anymore, particularly the consumer. And when you hear from the banks, when we break down the numbers and you hear from the likes of, say, Bank of America, and then you see the average FICO score, the average credit rating, and it's running in the 700s. And if you're not familiar with credit scores outside of the US, in the 700s, the high 700s, low 800s, is an incredibly high credit score.
They've selected the businesses they want to stay in, and they have undershot some of their credit provisions for a long time. And it really comes down to specific spots of issues. I'm talking about subprime auto loans that were extended out over, say, 10 years that people had to pay back, or remittances that were directly tied to immigration policy. Are those pockets idiosyncratic? People have come on the show and said, yes, there still is anxiety in markets. What are we missing after so many years of bounty?
I think if you want the average as well, the average is 710, 715, something like that. Average credit score in this country. Something like that. Anyway, ridiculous. More bank earnings through the week, Tuesday and Wednesday. More Fed speak as well. Chairman Powell in the next 24 hours, going into the blackout period. The quiet period starts for the Fed this weekend. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Lizzie Burden. Hey, Lizzie.
Hey, John. The US government shutdown entering its third week, and both sides are hardening their positions after the White House ordered the first round of permanent layoffs on Friday. But Democrats are sticking to their demand that Republicans negotiate an extension of healthcare subsidies before they'll agree to a stopgap spending bill. Elsewhere, JP Morgan announced a plan to invest $1.5 trillion in US security industries over the next 10 years. The campaign will ramp up the amount of capital, resources and personnel that the bank already dedicates to a variety of sectors, such such as rare earth minerals, pharmaceutical precursors and robotics, or ventures developing defence, aerospace and energy technologies such as drones, battery storage and grid resiliency. And a nor'easter is battering the East Coast, causing major travel delays, flooding and power outages. As of 4 p.m. Sunday, more than 230 flights were cancelled and over 4,000 were delayed, according to FlightAware.com. The US Weather Prediction Centre said that today would be raw and miserable. That should be my brief, John.
Lizzie, thank you, and thanks for this morning. Thank you very much. Up next on the programme, setting you up for the day ahead, plus John Boivin of BlackRock with the US dollar dominance in question. That conversation up next.
We've already started to see weakness emerge in some of those tariff-related sectors, the consumer-related sectors. And as we think right now, I do think that what benefits these bigger cap names in the S&P, that can keep earnings afloat. But frankly, we do wonder if we're starting to get the peak levels of sentiment.
Calvasina of RBC looking ahead to earnings season. The big banks kick things off tomorrow with JP Morgan. As we count you down to the opening bell, 42 minutes away. Equity futures nicely positive, up by 1.2% right now on the S&P. On the Nasdaq 100, up by around 1.8%. As we count you down to the week ahead, tomorrow, here's the lineup for you. Your trading diary shaping up as follows. Bank of America earnings will be coming on Wednesday. We'll hear from Citi and Goldman, JP Morgan and Wells tomorrow. Look out for all of that. Plus Fed speak from Bowman, Powell, Waller and Collins. On Wednesday, you get B of A, Morgan Stanley and United Airlines will be reporting. On Thursday, a lot of data, all dependent on the government shutdown. So let's park that. Let's turn to the US dollar. The index down 8% year to date, facing ongoing volatility. John Boivin, head of the BlackRock Investment Institute, writes, we see the US dollar slide tied to expected Fed rate cuts and fiscal concerns, not evidence its reserve status is under threat. John joins us now for more. John, good morning.
Good morning.
How difficult are people finding it to draw a distinction between one and the other?
Yeah, I think, if you look at this year and the commentaries around the dollar and so on, and connect the dots between, uncertainty on policy and so on, it's easy to tell a story that investors are more skittish about the dollar, and it's a specific dollar kind of risk premium that is being applied. But, when you look under the hood and the facts so far this year, there's no massive disconnect between the dollar weakness we've seen and historical fundamentals behavior. And so on the face of it, there might be down the road question about the reserve currency status, but I don't think we have the evidence for it yet. I think, moreover, when you look since all the discussion about central bank independence and so on, heated up over the summer and a bit before, the dollar didn't really weaken against other kind of G10 currencies. So we think it's more of a broader fiscal story globally. You see a yield curve steepening, and that has some impact on gold versus currencies. But I don't think we see really a U.S. dollar kind of reserve currency trade yet.
I'm glad that you brought up gold, because the dollar has depreciated dramatically against gold. And you could argue that the only reason why you haven't seen a greater weakening in the dollar is because nobody else is much better. How much is this absolutely debasement, but represented in gold? Not necessarily anything specific about the dollar as reserve status, but just generally a change in the global financial system.
Yeah, I think there's more to that, I think, going on right now, which is how we will resolve these fiscal outlook globally. We see what's happening in France. We see Japan, the U.S. So I think it's a common story. The gold is attractive in that context. I'm not sure, if it's going to be a long-term trade. But clearly, when the market is a bit more anxious about these questions, we see a narrative that bids gold up. It's been playing up. It hasn't worked for a long time, but it's been working this year for sure.
You talked about a yield curve steepening. And the more we talk about this, the more I question why we're not seeing an even steeper yield curve, why we're not seeing even more of a sell-off in long bonds globally and developed markets, given some of the fiscal concerns and given, frankly, this debasement that we've been talking about. Does that strike you as odd?
I think we might be getting lucky at this juncture, where the U.S. economy might be weakening just enough so that this doesn't really come to head just right now. We were a bit more concerned coming into September that you would see, inflation maybe not behaving. Last time I was here, I was talking about like the doubts we had about the ability of the Fed to cut as much as the market was expecting. Now we are a bit more confident that the Fed can deliver. The macro is weakening enough, and that's going to help relieve some of the debt servicing cost tension that were happening. So we might be for the next few months, or I don't know for how long, in a more of a lucky spot where these concerns are not really coming to head. But underneath that, I totally agree that there's a bit of a disconnect, and that's why we think longer term we'll need to see long-term rates go up from here, and a 10-year closer to 5 makes more sense for us than 4%, a few years down the road.
John, when you say there's no evidence right now that the dollar's reserve currency status is under threat, what would you see if it was? What would be happening?
I think you would. So you look at this year, more than 50% of the weakening that we've seen can be attributed to the increased easing expectation from the Fed. So just the interest rate differential story that we've seen this year playing out explains a big part of the move. And then, the yield curve steepening, investor asking more for a term premium for, holding debt, U.S. debt, maybe that has played some role as well. But the point is that if you look at how the dollars behave relative to term premium, the VIX, or interest rate differential historically, that relationship hasn't really broken. If we were seeing that relationship break and the dollar being much weaker than these fundamentals suggest, then I think that would start to be evidence that the investors are asking for more than just the fundamentals, and they're more worried about the dollar.
What signal do you take from the relationship between gold and risk more generally? The equity market move paired with the gold move this year.
Yeah, I think there's a story around some concern of fiscal dominance maybe playing out down the road. Not a reality, but markets are paying some credence to that. But at the same time, before you get there, you have an environment that's going to be pretty supportive for equities. So I don't think there's really a disconnect. It's an easy financial condition world, maintained for longer bids, equities, but you want to get some insurance with gold.
Do you think we are on the path towards fiscal dominance in 26?
I think this is a huge call, and one thing that I keep saying is in 2025, one thing that we need to guard against is extrapolate from what looks very dramatic in the near term to long-term consequences and big change, right? So on a day you see some headlines, you can be tempted to see, I never would have expected to see a headline like this, so hence we're going to see fiscal dominance. At the same time, I think these are big steps. There's going to be equilibrium forces playing out. So I think this is something you need to put more weight on than you would have had historically, but I don't think this is a default scenario.
Lisa's talked a lot about this. You look at the Treasury, they've aggressively shortened duration. The Federal Reserve, under this leadership, is putting a priority on cutting interest rates, or at least a bias to reduce interest rates, even with inflation around 3%. Now, that might not be fiscal dominance per se, but maybe the symptoms of it, the consequences are similar. There's some crossover here, which I think speaks to the gold trade, doesn't it? To some extent, at least.
Yeah, I think as long as the macro picture evolves in a way that, it sounds cynical to put it this way, but there's a proper cover for cutting rates from a macro perspective, markets might be concerned about what's really the motivation behind that and whether it's sure. As long as we have the proof of it, I think we're going to run with, we're not in the fiscal dominance world just yet. But I think it's going to depend on if we reach the point where it's really very hard to explain cutting rates just on the basis of the macro outlook, and it looks like we're deviating, then I think it's going to be. I don't think it's going to be continuous. I think there's going to be a discontinuity at that point if we get there.
John, it's good to see you.
It's great to see you.
Thanks for being here. Thank you, sir. John Boivin there of BlackRock. Overweight US stocks, they like EM, and see gold and Bitcoin as potential diversifiers. Coming up tomorrow, Keith Lerner of Truist, Gerard Cassidy of RBC, Lisa Shallard of Morgan Stanley, and Republican Congressman Mike Lawler. A lot still to come this week from New York City. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.